Check 1, 2. Check 1, 2. On the stream. I don't know if it's the internet. I don't know if it's Microsoft. Pissed. I don't know why it doesn't work. I don't know if it's got to be something with AI. I don't know what it is, dudes. This is it for me. I swear. Oh my god. I want to peel my face off. I really do. I don't know what to do at this point. I think I have a lot of patience. I think I'm a patient man. Save. Put that up for me, please. I don't know if I can see your chat now. I have no idea if it's repaired or not. I don't know what's going on in the background. It's ridiculous. I don't know what's happening. I don't know what's going on. I'm literally living in it's like the most absurd thing. Good morning out there. How y'all doing? I don't know what to say. I think maybe... Hold on a second here. We'll switch over. Let's move to a quick chat really quick. We're going to let everybody chat today. We're going to let the Russian bots chat today. What else are we going to do? It's like the biggest day of the quarter, and I'm not live streaming. And it's completely fucking absurd. Why is probably... Tell me the camera's on. Oh my fuck. I guess I'm demonetized already. The first 5 seconds of the show. And so I don't know what's going on. I want to assign it to kittens or cats walking over my keyboards, possibly. That was my initial thought process as to what's going on this morning. But then my internet is being intermittent right now. I don't know what's going on. I've got intermittent internet. I know for sure. My internet is like cutting in, cutting out. I don't know. I had an update for Chrome that I was pushing off. It looks like it was forced. I don't know what the fuck is going on. Like my audio is all fucked up on Streamlabs. Like major audio issues. Can't log into Thinkorswim. Couldn't log into Discord at one point. I don't know what's going on. It's if I had to guess, it's got to be something with Microsoft or Chrome. Both have been updating stupid updates. Windows 11 is a fucking disaster. It doesn't interact with anything anymore. And that's the reason why I use Windows and not Apple is Apple's very gardeny. And Windows wasn't. Now Windows is attempting to, through AI, I think, decide whatever they're like. I think Windows 11, in some fashion, behind the scenes, is like I don't know if it updates. It'll do is it'll be like, oh yeah, I don't know what these settings you did over here, buddy, but we're gonna reset all this shit on you and decide what your mics are, your audio is, what you're hearing, what your monitor is, what all these other fucking soundboards are and stuff like that. So I apologize, and I don't know what to say to you because it's so absurdist at this point that I don't know what to do. And then Streamlabs is even worse. Once all this stuff gets reset, I'll go back in and try to fix it, and it doesn't stick or take. I have to like reset Streamlabs 2-3 times to get the new changes to actually take hold in Streamlabs. And I don't know what to say about. I should record this at some point because whenever this happens, it's a fucking disaster for hours. It's a straight disaster. So maybe I'll just go back with. I think I'll just use kittens as my my excuse, I guess, at this point. Anyways, this morning, huge move higher, right? Let's go over the trigger screens really quick. We had a target up here in a brief last night for 545, right? And I was like, yeah, maybe we'll hit. I thought I have to bring up the brief, but I thought that we would hit 538, come back down for the FOMC decision, and then trade 540, and maybe Friday trade 543, 545. And that is not the case, is it? We always talk about time or price on this show, on the briefs, what we do here. And we're like, and people are like, why do you erase the dates? And I'm like, it's either price or time. So I don't want to give you dates. I want to give you the price targets and not tie into a date. And I am blown away where we are currently this morning. Trading 545-ish. This is this yellow box here, this 550 and 547. This is a weekly RTX sell. I don't even think this is daily. This might be, let me check this and make sure I got this right. Okay, so 1 day. Let's see if this is the, yeah, so this is the 1 day expectations for an RTX sell at 547 and 550. So you can just see this right as a red line there and a red line there for upside expectations. You know, last night, I think I put this in the brief last night. I think I wrote about this in the brief that I was looking at weekly expectations or weekly expectations on SPOOs. And I was like, this is absurd to even think that we could go there. And we're there. Inevitably, we are there. We were here at 10:35 this morning. Obscene. I don't know what else to say about it other than obscene that we're at that price. I had zero expectation that we would be parked right here at 10:30. By Friday, yeah, possible. Well, that like Thursday close, parked right here, definitely possible. 10:30 this morning, no fucking way. 5% chance of that happening at most. 5% chance that we would be right here at 10:30 this morning, and it means something, right? We talked about 6,000 back in November, December. We're at 540, June 12th. And I don't know if things are going to get out of control or not. We've talked on the show about the 1990s, where the late stage 1990s, we were literally going up. I kid you not. 60% move up, 40% move up, then down 20%, 30%. Cumulatively, it wasn't too crazy. It was like 300% gain or something like that on SPY or SPX, excuse me. But what the fuck to say? If this does happen, you know, you got like, who's that David guy out there? He's like 9,000 or something. There it is. This is the behavior of something like that. That's the behavior of it. It's that fucking insane. So I don't know if that does begin to happen or not. I don't know if this is indicative of that happening or not. But 5,500, 5,600, round the corner. Round the corner in June. We're right there. We're up here. We broke through. Congratulations. Good job. Trading at a high this morning at 543.95. It's absurdist, which is awesome. But here, let's switch over to this screen here. It's absurdist, but it's awesome. It really is. It's awesome. And I'm sure that most of the market is stunned. That I don't think they're stunned that we got there. I think they're stunned at the time, 10:30 in the morning. The inevitable conclusion of upside. We had a breakout at the close yesterday, and which pointed all points yesterday. The brief last night was like, yeah, we're fucking there. We're going. I took a trip around the market yesterday at the close, and I went through all the sectors, everything, and I'm like, this whole fucking market is about to explode to the upside. And so I put that in the brief last night, and I read something to you in the show yesterday, and I want to read it to you again. Someone was asking about it in the Discord early this morning. I saw someone saying Cap read something to the chat yesterday, or in the stream yesterday. I'll read it to you again. Someone was asking what I had read yesterday to the chat. I'm going to read it to you again right now. And so I can catch up on that from yesterday. And let me see if I can read this to you again, because it was kind of stupid, right? Hold on here. And now I see conversations this morning on the news asking if they're going to start cutting rates at the FOMC today. I don't know if that happens, but whatever. I don't know. But I'm going to read to you again what I read to you yesterday before the close. Bank of America sees broad-based equity inflows. This is a repeat of what we went over yesterday before the close. Bank of America, this is from Bank of America yesterday at 2:30 in the afternoon. This came out. Now, before yesterday, or I should say this, I should start with this. Thursday, I think, Thursday or Wednesday in a market brief, I went over GS, JPM, and Bank of America, what they were making public from their trading desks, and they were kind of leaking that everybody was long, but they weren't giving any hard data on it. And then yesterday, BOFA came out. BOFA D's nuts came out yesterday, and they made another statement, and I read it to you on stream near the end of yesterday's show. And so someone this morning was asking in Discord, hey, what the fuck did Cap read to me yesterday on the show? So I'm going to reread it to you right now. Bank of America sees broad-based equity inflows. First net buying in 6 weeks. Last week, during which the S&P 500 was up 1.3%. Securities clients were net buyers of U.S. equities for the first time in 6 weeks. $1.9 billion, with inflows into both single stocks and ETFs, led by single stocks. The largest single stock inflows since December 2023. If you remember, in 2023, we had the initial rip higher in October, and then we had that check back, and then it was boom, off and running. So this is led by former, the largest single stock inflows since December 2023, and across all size segments, small, mid, and large caps. Private and hedge fund clients led net buying. In addition to corporates, below with inflows for a second consecutive week and inflows for the first time in 4 weeks, respectively. Institutional clients were sellers for the second week in a row. Now, we're going to come back to this the corporate types in a minute here, because there's a book. It's, where is it? I got it over here somewhere. This book right here talks about it. The New Market Wizards. This book here talks about when the corporates come out and buy, and they're usually late cycle. They're usually late cycle buyers, and they're talking about it here, BOFA. Institutional clients were sellers for the second week in a row. Near record buybacks. Bank of America corporation client B of A corporate client buybacks give an early read on S&P 500 buyback trends and suggest a continued pickup. Corporate client buybacks last week were the second largest in our weekly history since 2010 and have been tracking above seasonal levels for 13 weeks. Year-to-date, corporate client buybacks as a percentage of the S&P 500 market cap, 0.44%, are above 2023 year-to-date highs of 0.34% at this time. While this report does not include sector-level granularity on executed buybacks, note that 70% of the announced S&P 500 buybacks year-to-date have been in tech and communication and telephonic services. So they're telling you that the fucking whales are here, or the elephants. I used to call them elephants. The elephants are here. And they were late in 2020 as well, in 2021. They were like, I think they got in September or something. So they're early on a date year basis, but they are usually late cycle or they enter late cycle. So it says that they're here. Price here is showing that they're here. The entire fucking market is being bought hand over fist. And we're now trading 5:45 at 10:30 in the morning. Were any of you expecting 5:45 at 10:30 this morning? Anybody? I was expecting it maybe Thursday, maybe Friday. Thursday close, opener Friday. But certainly no fucking way was I expecting it 10:30 this morning. Boom, big man Shaq. Okay, so you were expecting it this morning. Okay, so is anybody expecting it at 10:30? 10:30 this morning. 9 a.m., 9:30. Anybody out there expecting that? Anybody out there in the chat? Anyone want to raise their hand and say, yeah, I expected it, bro? If anyone out there did expect it, I want to hear what your expectations are next. Because I don't fucking believe you. I don't believe that you did expect it. Because I want to hear what your next projection is, because I know it's going to be wrong. That's right. That's the answer. And that is the answer. The idea of this happening by 10:30 this morning is a probability of I would bet it's like 3%, 5%. I think the probability of getting here is high, but not at 10:30 this morning. No fucking way. No way. No way were we trading R3 on the opening bell this morning. No fucking way. Not on SPX or SPY. Anyways, I was setting you up. You guys are getting too good. You guys already fucking know whenever I ask a question, you're like, he's setting us up right now. Don't answer him. We're going to go down the fucking rabbit hole with him. He's going to ask you like 2 or 3 questions. And by question number 4, he's set you up. All right, so right now we're trading. So here's a few. We're going to talk about a few key points here. As per the brief last night and the day before, treat this morning's data release separate from FOMC. So the trade for this morning is over. I want you to realize that the trade is done. This is over. This is done. We did it. Woo! If you're a bull, high five, slap yourself in the back. Good job. Next, we have FOMC meeting. That is at 2 p.m. Not the meeting, but we have the press release for the rate decision from the FOMC and Jerome Powell. And then at 2:30, we have the presser with questions from the press, right? And they're going to have some pointed questions, depending upon what Jerome says. Now, as of right now, Timros has been wrong 2 times. I think that Jerome was kind of pissed at the media, at reporting, and at all, like all of it. At the time, he was being accused of pandering to the White House and the election. And I think it got to him. It seemed like it pissed him off. And he became a little adversarial through Fed speak at the last 2 meetings. And Nick Timros twice was way off base. And what was going to be projected from Jerome Powell. Now, this 3rd time, maybe he is right. Maybe he's right this time. But Timros made some comments yesterday. Maybe he's changed them since then. But I'm gonna stick it to him again today. Where Nick Timros was saying what? He was saying, let me see if I can bring this up. Where the hell is that Timros comment from yesterday? Investors will obsess Wednesday over whether Federal Reserve officials pencil in 1 or 2 interest rate cuts this year. For policymakers, difficult decisions and looming divisions over whether and when to cut interest rates are a problem for later, not right now. Instead, the fixation on the quarterly rate projections obscures remarkable cohesion among rate setters over their wait-and-see stance. After concluding a rapid series of rate rises last year, Fed officials remain widely united that the best course of action for an economy with solid growth and inflation still running somewhat above their target is to make no moves. In effect, they are taking the summer off to evaluate how hiring, spending, and inflation are faring 1 year after they lifted rates to a 2-decade high. Now, this whole entire 3 weeks, I've been going down the deep fucking chasm hole of the data that we've been receiving. And I mean like deep. Normally I'm like, yeah, there's the numbers, we're good. Past 3 weeks or so, I'm going down the fucking rabbit hole on this shit. And I've expressed to you on this show that the job is done. The job, or it's done for where we are. Can we raise rates again? Yes. Is it appropriate to raise them now? No, it is not. Most of the data says that the Fed rate hikes have done their job, and also that there is risk of any continued rate hikes right now of actual damage to be done to the economy and damage done to the employment situation. And if anything, there should be discussion of letting the economy run a little hot at this point. And there's a reason for that. And I don't like what Timros is saying. I'm going to tell you why. Because there is damage being done. We got inflation numbers this morning too, right? There's damage being done to businesses, the economy, at all that kind of shit. And to say, well, we're going to look at it in the fall or the winter, that's too far from now. Too far. You could do irreparable harm to our economy if you continue down that path as it is right now. And further to that point, if you're going to take the summer off for a vacation and come back, the jobs market and employment is just recovering. And if you look at it back to 1940, it looks like this. Our job market participation rates, right? 1940. It's like here, right? And then it went down. And then it came back, down, came back, down, came back, went down. And literally, COVID, right? Then we have COVID right there. And we are literally right here at this point. That is where we are. We're right fucking there. That's where we are. And you're telling me that you want to continue with rate hikes. What, do this? You want to get back into COVID? And the answer is fuck you, no. You let this breathe a little bit. You let the labor market recover a little bit before you do any more tightening to bring it back down if you want to bring it there, I guess. But you don't want to be right now going, yeah, you know what? We're going to hammer it one more time. There's we're at the bottom. We're literally at the fucking bottom of workforce participation. And that's real. So if you look at employment is separate, employment, unemployment, jobs, wage growth has its own fucking thing. And then you look at the economy. This is like producers, or this is producers, then retailers, and then you look at small businesses, medium-sized, large-sized business, and then the consumer, right? All of that stuff as one thing. Two separate things, right? The job has been done on that other fucking side, and the employment side is at risk of some damage. And you do not want to see wage stagflation. You do not want to see unemployment ramp out of control, velocity in unemployment. And if the Fed is going to say to you, well, we're going to fucking take the summer off and we'll be back in the fucking fall or winter, that could be dangerous. You could get to a point where you've got out of control government spending, right? Because it's an election year, and then we got it all over the world because of the highest rate of election, or most elections we've ever had around the world is this year. That's fucking with our GDP numbers. And then you get the Fed over there dicking around in the background at the same time. And they've done their mandate at this point. And then you've got unemployment ramping out of control into December. This fucking sounds bizarre to me. So I think there's a discussion to be had today from the Fed and from Jerome Powell, where they discuss with you letting the economy run hot. I don't like the idea of just, hey, we got great CPI numbers this morning. Let's fucking leave all these rates on. I guess you can leave them on, but the discussion needs to be had, or at least the Fed speak needs to be there to open the door to a rate cut sometime in the fall and winter. And maybe they tell you you get one, but that's it. Don't expect two. Don't expect 50 BPS. Don't expect huge rate cuts. You might get one from us. We might let the economy run hot and expect more rate increases down the road. Learn to live with higher rates. Maybe not at 5. Maybe it's like 4.5, 4.75, something like that. And we'll address it in the winter or 2026 if we need to make more cuts or more hikes. But for right now, for their mandates, getting inflation under control, robust employment, we are not at robust employment. We are not. None of the data says we have robust employment. How do we get robust employment? A rate cut. A rate cut. That's it. That's how you do it. So I don't know if we actually get the rate cut. I don't know if we actually get that rate cut or not today or in the future. Don't care. I just know that conversation needs to be had by the Fed. And the Fed needs you, even if you disagree with it, even if you disagree with it out there right now. conversation needs to focus on one specific thing. Getting you to swallow and eat. I don't care if they shove it down your throat. That a recession is no way better for you than running the economy slightly hot. Running the economy slightly hot is better for you, believe it or not. I know you don't want to believe that, but it really is. It comes down to a case of, well, it didn't happen to me, or I'll take my chances. But in reality, recessions hurt more people. Now, this is like a rat trap for young people. You'll eventually catch up. We'll run it hot. You'll catch like 5 or 10 years where you finally caught up, and then we're going to have another COVID, and we're going to fuck you again. The truth is, you probably do want the recession if you're young. You do want to wash out all these people that we went over yesterday. Remember, I was telling you yesterday about all those people that are like, "Oh, I'm a mid-sized company, and we're not using expenditures, and I've got variable rate mortgages for my company and all this other stuff, and so we're not spending any money right now. I'm a little scared here, but hopefully they cut rates so I don't get washed out of the debt cycle." Those people, they just want to hang on a little bit longer. We need to wash them out, of course, by raising rates. I just don't think it's today. I think it's down the road. I think we raise rates if we can, if we don't come into the end of this fucking cycle in 2025, 2026. If we can skate through and not have a 2001, 2008 disaster on our hands, or even if just the promise is there. Yeah, you know what? We just took a hit in Michigan, too. Marmot Bird just said property valuations came out and property values are down 30%. I just looked yesterday in Michigan. Detroit is off the map booming, but Michigan, the state, is down 30%. Down 30%. I looked at a house last night to buy, and that house's value came down 30%. In Northville, Michigan, it's like one of the nicest communities in the state. It's wealthy. It got hit with the price spikes and stuff, like $350,000 homes now running for $500,000 or $600,000. $600,000 homes now running $900,000, and they've all come down about 30% at this point. Same thing over here. Same as you, Marmot. Okay. So let me ask you a question out there. After this morning's report, I want to ask you, what do you think the Fed is going to say today? Let me ask that because we have a second trade coming up. Let me ask you, what do you think the Fed says today? Do you think the Fed says, you know what, they're going with Nick Timrose? You know what, fuck you, everything is awesome. We're out of here. We're taking the summer off. Rates stay the same. You're not getting any dovish talk. You're not getting any hawkish talk. We'll see in the fall. Oh, God, Royal Oak. There's hippies in Royal Oak. Aren't they fake hippies in Royal Oak? Royal Oak's a weird-ass place. I don't get it. I don't get Royal Oak at all. Yeah, you're saying properties are crashing everywhere. Dovish, they won't cut, but put it back on the table. Unemployment increases has to concern them. I'm with you on that. Unemployment is a concern. And CPI year over year today was 3.3%. So it's in line And that shows that we're going to have at some point 2% inflation, right? They've done their job.
31% of votes in the first round of the French legislative election.
They will talk soft, probably prep the markets for cuts in September.
Party and allies expected to win 18%.
Split dot plot. They talk about progress made, but more data needed. Still show 1 or 2 cuts for 2024. No change. A slight chance, not to be provocative. I think truly, I'm with you on one thing here.
Now only $99.
I'll say one thing. If there was ever a probability of a surprise cut, it would be today. If there's a probability of it happening, it's a low probability. It was like 5% before today or before this meeting. We talked about this yesterday too, right? This meeting has an actual, still a low probability, but if there was going to be a cut that was surprised, this would be the meeting for it to happen. Otherwise, I don't think you're getting a cut at all until fall or winter at best, if not Q1 of 2025. But I think they're going to prep you for it. I think they're going to prep you for. Are they going to have the? I don't think they're going to prep you for the cut. I think they're going to prep you for. Listen to me closely here. I think they're going to prep you for letting the economy run hot. Some kind of conversations around that. We've done our job. We did what we wanted to do. We expect year-over-year inflation to come down to 2% by next year. We've done damage to we've slowed the economy down to where we think it should be, and we think the job is complete. And we're wrapping it up at this point. That's what I think. Now, do I think that's real? No. I think you're going to be living with rates for a long fucking time, unless something existential happens. Just the business cycle, just a long-term debt cycle comes in. Stuff like that. There is an argument here, too. There are prior Fed presidents that have written autobiographies where they have stated explicitly, listen to this, that they don't know if what they do actually makes an impact. There have been Fed presidents that have said, we try to time it where we think the business cycle is anyways. So we've had Fed presidents say, we don't know if this actually has a true impact. We actually work, or we try to gauge where the business cycle is, and we use our tools with this idea of where the business cycle is. We don't know if it actually works or not. We could probably not do anything and would still go through that cycle. And Jerome, in particular, brought up recently, I think 3 rate decisions ago, he said to a reporter, look, we finally got the COVID business cycle and our normal business cycle in line with each other. And we had discussed that prior to him addressing it, where we said, hey, look, there's a business cycle, or normal business cycle, right? And then you got a longer term business cycle as well. I guess it would look more like this. You have a short-term business cycle, right, and a long-term business cycle. Here's the short term and the little waves, and then the bigger waves are the longer-term debt cycle, right, or business cycle. So you got the up and down of a longer-term debt cycle. Then you've got short-term debt cycles in here, right? And then all of a sudden, here comes fucking COVID, right? COVID's like, oh yeah, we're gonna dump a bunch of money bunch of money inside of the economy, and oh yeah, how's that? Woo! Awesome sauce. And Jerome's like, we got to bring that shit back together, make it one again. And he addressed that recently, saying, hey, we just did this. We just fit it. We just got them back in line with each other. Congratulations. Pat ourselves in the back. Now let's talk about the cycle being as one. Jerome is not going to rock the boat in an election here. He's played it so cool, the market pumps almost every single Fed meeting. 3.3% is nowhere near 2% cap. I will address that in a moment. Saying it's not anywhere near 2% is inaccurate. Their target is 2%, and I'm going to show you the charts showing you how we get to 2% from here and how. So we're on that trajectory is my point. So if you've got 2% right here, 2%, right? And we're at 3% right now, right? 3.3%. And I'll actually show you the charts. Jimmy, I'm going to show it to you in just a moment, okay? So you got 3% or 3.3% right here. And you're heading towards that 2%. The idea here is that if you've already done this action X to get here, that the idea would be that X is working for you to ultimately get to 2%. You don't step in here and say, you know what, we're gonna do X plus Y right here. So if you're heading there slow, now you've accelerated and you get the bounce, right? You get the cuts right here. You accelerate down to 2%, and then you ricochet off with multiple cuts. I'm trying to simplify this. Some simple crayons for you. But the idea being is that the work that's been done has you attaining 2%. And I'll show you the actual charts here in just a minute. I want to bring those up for all of you to see. I showed them on the show recently. I'm going to show them to you guys again in just a moment. I'm Straddle King for today. I think no cut, but we'll be watching. We'll say watching numbers to determine it makes sense to cut post election. Give me rate cut today. If they do cut, isn't that a bearish thing? Yes, it is. Well, it is and it isn't. We have had cuts. We have examples of having like one small cut in the past where we raised again in the future. The initial reaction is bearish, not as bearish as multiple cuts, like cut to zero. But it is still bearish even on a smaller or instead of SPY going down to fucking 3,500, it'd go to like 4,600 or something like that with like one cut. The trick in that pony is making you and I and the banks and everybody else believe that we're not going to have multiple cuts. That's only one, and we're likely going to go back in and raise rates later. You think we get a surprise cut? The best markets are between the last hike and the first cut. It's a carried out there cut, but once we get a cut, it's a sell the news and the markets roll over. 100% SurfX. Majority of the time, whenever they do start cutting, it's because they've over tightened, right? And they're chasing, right? And the banks set us up for that cut. They set us up for the cut this year. The run from October into February, they were ramping the markets, expecting a cut, and they fucking positioned us at that rate meeting in March for a cut and a bloodbath. We didn't get one. They drank the Kool-Aid and thought we were actually getting a cut. We either go to 545, 550, or back to 537, 535 by Friday. We're going to address that in a moment, too. Good questions. Jimmy's got it up. Jimmy's on point this morning. So we're going to talk about where we are going. And we're going to talk about the 2% inflation at this point. How do we get there? Or how are we already there? We got CPI here at 3.3% for year over year. And how in the fuck are we getting 2%? I'm going to show you guys in just a minute how we get there. No way they say that. Year hike in Q1 with the media blaming Trump, or rate cut in Q1 for unemployment with the media blaming Trump. Why do they take out rent, food, energy, cocoa if they have a job? Fuck your puts, fuck your calls. I'm going balls to the walls. Right on, Kenny Tran. Any mission accomplished banners that will be the White House? I don't think there's any mission accomplished today. I don't think it's mission accomplished. I think Jerome is going to address employment, unemployment, and wages. You and the Fed are effing dreaming. Inflation since 2021 is over 20%. 20% for those of you not good with the numbers. Yeah, now we're arguing what the inflation gauges they're using, right? We're not going to get into that here. I'm with you on that, but that's not what the Fed looks at. Take out homeowners equivalent rents like the EU does. We under 2% right now. Will you be streaming FOMC? Yes, of course. We're doing the FOMC today. I'll have it on live. You'll hear it in the background here. I'll have the news squawker on. I'll have the report in front of me, and I'll read it to you in depth, like we always do. We do the FOMC meeting. This is our thing. I don't know why we weren't on in time this morning, but this is normally our bread and butter. If they cut rates, the market will tank. Agreed. If they raise rates, the market will tank. Rates will be on hold till the end of the year. I think I'm in with. I think the greatest propensity is I'm with you on that, Jimmy. I think that the greatest chance here is no rate hike, no rate cut, and data dependent. That's the highest probability today. I think your next probability is a discussion about letting the economy run hot and trying to get the public to eat that pill between now and the election. Guys, it doesn't matter what real inflation is. They're going to make everything look good to the election. Agreed on that, too. Thanks, FX Retracer. Is backward looking. They'll try to front run the rate cut to align with the anticipated 2% strike. I'm going to go over that with you guys in just a moment here. What's the point of cutting then raising? Because of the rate, the slope of how we raised rates. It's a good question. The time that it took for us to rate the quickness and how quickly we raised rates was very fast. It wasn't a slow process. They attacked it. So they got to lay off it a little bit. It's kind of like, how do I simplify it for you? So let's say you and I had to go to a wedding and we were late to the wedding. And there could be some bumps in the road or an accident that could stop us. It's like 10 hours away, right? And we're like 2 hours behind. We have to build in a buffer, right? So we speed. We get a Ferrari and we just, instead of going 55 and a 55, we're going 95 and a 55. We make up all that lost time, and now we're on track again. What do? You lay off the gas, right? And you go back to 55 miles an hour. Does that make sense? So we caught up, and you lay off a little bit. Does that make sense? Yeah, so chicken fried, I'm with you. But you're literally talking to yourself in a corner. You're screaming in a corner. Jerome doesn't care what you have to say, does he? I understand what you're saying. I'm in agreement with you. 100%. He's not looking at that, though, right? So it doesn't matter. Is it material to our market? No. I'm with you on this. I agree with you. I agree. There's something else here, chicken fried. I want to clear this up, too. I saw this on Reddit, and it bothered me deeply. There's like 10,000 comments on a post on Reddit, and they said something about how they were like, they keep saying inflation's come down, yet the price of eggs hasn't come down. And I'm like, these people don't realize that when they bring inflation down, that doesn't mean the price comes down. It just slows the rate of price increases. So if you have a product that costs $1, and next year the product costs $1.02, right? And then you have an inflationary moment like we did during COVID, and that product goes to $1.50. $1.50, let's say, or $1.60. And let's say inflation comes back down. Guess what? That product a year later is now $1.52. It doesn't go back to $1.02. It just slows the rate. What you're asking for is disinflation, right? You want these prices again, right? So we have to go what? We have to go negative, don't we? We have to go negative, right? We have to create a recession, don't we? Or a depression. We have to destroy demand for eggs, don't we? How do you do that? I take your fucking job away from you, don't I? So that you're poor. So you can't fucking drive the price of eggs up any longer, right? Not you, but, you know, you get what I'm saying. So you don't actually bring prices down. You just are slowing the rate of inflation long enough for jobs, wages to catch up, and long enough for you to accept those higher prices. And these producers and companies only get an event every 10 or 20 years where they can make those price increases, right? They don't want to bring the price of eggs back down, do they? Why? Think about you as a consumer. When you buy hamburger, right? When you were out there buying hamburger, and you have in your mind what the price of hamburger is, you're like, hey, hamburger costs me $3 a pound. And then one day you go to the shopping center and you see that hamburger is at $4 a pound. And you go, you know what? I ain't buying that this week. I'm going to wait until it goes back on sale again, back to $3. Fuck those guys. And so you do that, right? In your regular life. And you expect that $3 fucking hamburger year in, year out, year in, year out. And the person that's producing that knows, they know that you expect $3 a pound. So in their own business models, they say, I can't wait until I can jack the fucking shit out of that and people will eat it. They'll accept that the prices are now higher. So whenever they get that chance, they take it. They literally build it into their business plan. They literally say, for the next 10 years, I can charge now $5 a pound. I'm going to make all this money in the first 3 years. Then I'm going to stop making as many profits at year 5 or 6. I might lose some money in year 8 or 10 or 8, 9 or 10. We actually start losing money. But in that 10-year cycle, we're net positive. It's okay. As soon as that next event hits the tape, I'm fucking going from $5 to $7. And you can see that going back to the start of the U.S., right? You look at old-timey menus. Hamburger was 3 cents. Now a hamburger costs what at McDonald's? $30? Something like that. They never bring the price back. They never do. Even when we're in disinflationary periods, they still creep back on us. They still do. It's constant forever. It's never, ever, ever ends. That's right. They print and print and print and print and print and fucking print. And they devalue the dollar. It's gross and disgusting. Right now, what they're doing is some of the most offensive shit I've ever seen. Most offensive. You've got a population decline in this country. You've got people not wanting immigration. Nobody wants immigration, from what I can see. Seems like nobody wants immigration, which is bizarre. We've got low birth rates. We have one of the largest older populations living longer in their lives, living longer than ever. They're active. Even though our death rate's gone down since COVID, it's still obscene how old people live today. And we have population decline. And we are fucking paying them Social Security right now. We're paying them. You are a young person. You're paying them something that's about to implode. And they're fucking spending in the government right now based upon a population that won't fucking be here. And we're going to have a population decline in this country. And who's footing that fucking bill? You are. You're going to get hammered when all these old people die. You're going to get hammered because you don't have the workforce. You don't have the population. You have one of the lowest workforce participation rates in history. In history. And you have population decline in this country. You're going to get we are going to get fucked. My kids are fucked. My grandkids likely will be fucked. Not my kids are already fucked, but I think the grandkids are going to be super fucked. 2 generations from now, there's hurt coming unless we change that. We either need mass immigration or we need lots of babies. One or the other. It's too simplistic to say rate cut, bearish, and bullish. No, it isn't. Statistically, rate cuts are always bearish. It matters if the banks have positioned for it or if it's unexpected, if the rate cut is unexpected. If it's unexpected, we'll squeeze and then sell. If they know it's coming, they will position for it. Statistically speaking, 70 to 80% of the time, it's bearish. It's bearish. That's enough. That's enough of a percentage of the time that if we get a rate cut, it's bearish. Or you would trade with that expectation that it's bearish. We know it's false, Jimmy. I know it's false. I know it's false. Chicken fried was mentioned it earlier. I agree with chicken fried too. I know it's false. You know it's false. You know that they're using a metric that's not real. All right, I'm trying to make my way through. I'm so far, but this chat is blowing up. It's an awesome chat, by the way. I'm going to scroll through to the current chat because I can't get through all of it at the same time. Okay, so it's 12:22 in the afternoon. Chat is on fire this morning, or afternoon now. Chat is on fire with all good points. All things I agree with. I don't disagree with anything, literally, you guys are saying in the chat right now. Hey, thanks. I appreciate it. Thanks, Spicy. Great name, by the way. Spicy McChaggis. We still need affordable housing. You know, I got to give it to one place. I got to give it to Austin. Huge shout out to Austin, Texas. Have any of you looked at Austin, Texas? You can rent a fucking mansion for like $1,000 a month because they increased housing stock, right? Austin, unbelievable. Has anybody looked in Austin? Dirt cheap to live there. I can't live there. It's too hot for me. But what you get for the buck, woo! Housing, dirt cheap, all new housing. You have a feeling that a roll is coming on Apple. All right, so let's talk about today. Let's have a quick chat here. Let's get into what the expectations are into this Fed meeting. So let's first draw let's draw a line. Let's do a vertical line here. What do we got here? 2 p.m. Right there, 2 p.m. Bam. Right? Especially today. If you feel like you're like, I don't know what's going on, I don't know what the fuck the market is right now, I always recommend that you always revert back to the tools and the lessons that we teach you. It's the best way to do it. Whenever a stock opens for the first time, we use basic tools, don't we? To find out. As a matter of fact, has anybody been watching Reddit, the stock? Whoop, that shit's on fire. I meant to bring it up a few days ago and I didn't. But anyways, this is very similar, right? You have a stock that opens up, it rips faces off right out of the gate. And what do? How do you trade it? So let's see what we have for knowns right now. 2 p.m. we've got the Fed minutes, right? Or not the minutes, excuse me. We got the rate decision. 2:30, we get Nick Timros and gang. The Fed's mouthpiece. What else can we see here? Let's go right over this trigger chart and see what we can do with this. All right. So there's some things we can do here, right? We can check out some cool stuff here, right? We've got this right here. This is the initial pump. See it right there? Pretty easy to see. Make that green, right? See that pump right there? We got another pump down here, don't we? It's a pump show. We got another pump down here, don't we? You see that one? Let's take a look at a higher time frame for a minute. Let's go to a 4 hour. Look at that fucking thing. That's just pure ridiculous, isn't it? Hold on, let's look at this for a minute. Fuck you. 4 hour bar. Whoa. So we know some things though here, don't we? We know that this is where that pump started, right? So we know that that's there. Let's look at a 1 hour basis. Starting to get somewhere here, right? Pump right there. We got another pump right here on that bar. And we got another pump right here, don't we? So we got another pump right here. So you got a pump here. You got a pump here and a pump there and a pump over there. A lot of pumping going on, right? We got a pump right here. Buyers, buyers, and buyers. We know where the buyers are now, don't we? We know where they are. That's good to know, right? So if you're looking for a place to come back to, we know where the buyers are. We also know where the hourly trigger is, right? So we know that. We know that we can usually trade off of the hourly trigger, right? Or if we reject underneath the hourly trigger, that we can sell off of it, right? We know we can do that too, right? This is Mr. Reliable over here, isn't it? The hourly trigger is Mr. Reliable. If we're extremely bullish or extremely bearish, we know we can also trade off the half an hour trigger. If the half an hour trigger is moving near fucking vertical, we will trade off of it, right? If the half an hour trigger is moving at a slight upward, we'll likely go back down to the hourly trigger for a back test. Some shit that we actually know right now, right? So we're starting to firm this up. What do we know? What else do we know? We also know on an hour basis that this is where the sellers are, right? They're right here, aren't they? Make that yellow. Starting to firm up a trading zone, aren't we? There we go right there, right? Now we can see that we're stuck in the middle, right? Got sellers coming in here, buyers trying to come up here, sellers coming back down right here, trying to smash us through and break up this consolidation, right? Either distribute or consolidate and move higher, right? Pretty easy to see. Fairly easy. Let's go to a half an hour basis and see what we can see. Not too much, right? Looks kind of the same. Let's look on a 1 minute basis and see what we can see. That's shaping up here now, isn't it? We have a cross happening on the 1 and 5 minute triggers. Is that red? That ain't red. That's fuchsia, isn't it? What is it? Kind of red? Let's do purple. You want to do purple? Oh, kind of like purple. Purple. Oh, there we go. Red. We have a cross happening right now, don't we? 1 and 5 minute trigger cross at the moment. Right? They're sealing the deal right now, aren't they? What are we missing? The new low. Right? So we want to see price break down on that low right here. If it can break that low, we should see a drop, shouldn't we? To the next level right here, and that's your first target, isn't it? So let's take a peek at that right now. We're going to keep a very close eye right there. We want to see if price breaks below the green box. If you're a bear, what do you want to see? You want to see dip down, rejection, and bloodbath. And if you're a bear, what do you really want to see? You don't want to see us bounce right here, do you? You want to see a break below here. Even if we squeeze higher, you're looking for that new low right there if you're going to get really bared up, right? Because then you know that we're going all the way down there. So we'll watch price action as we roll down right now. Let's start with this. The next thing that we're going to look at really quickly is what? We're going to look at our triggers, right? Not our triggers, but our pivot points. You guys get pivot points, right? Let's take a peek at pivots. We rejected our 3 up here. Our R2 is right here at 540.30. And what's racing up right now? The half an hour trigger is racing up to this point, and the hourly trigger is racing up to this point right here at R1, right? See it? Hourly trigger will be whoop right in here, won't it? Whoop, bam, right somewhere in there. So downside expectations, if we're going to go down, 538.63. Get this one up here, right? 540.29. 2 important places, right? And they'll line up nicely with the hourly and half-hour triggers at some point. The pivot point is down here at 535.34. And you can see it's just below right here. Okay, so this is neutral here. Pivot point's neutral. Let's start to take a guess as to what we're going to trade. So how do we trade this if you're a bull? Do you know? You're looking for one of 2 things. You're either looking for a pullback to the half-hour trigger or the hourly trigger to buy that dip there, right? Or you are looking for price. For price to break above this previous high and then back check the 1-minute trigger and you jump in the trade right there. And then we start looking at new highs up here. Make sense? Fairly easy, right? So do you have a trade right now as a bull or a bear? The answer is no. There's no trade as a bull. And there's no trade because we don't have a new high up here yet.
Believes China
with a successful backtest, do we?
Work to stabilize U.S.-China relations.
Is that your trade as a bull?
That can escalate.
Do you have a trade as a bear here yet? Nope, because we didn't break this prior low yet, did we?
Seeking to reassure investors and others that they have a plan for the way ahead.
So you do nothing here at this point. Upside target. 550.16 and 546.87. Let's make this red for you. Right there. Oh, yeah, there it is. And this is a zone, not an actual tag. When we get into R4 and R5, it's a general area. Okay? We can stop like here. We can stop up here. They tend to be unreliable because they're a 2 sigma move on the day. We're getting better here, right? Starting to form all of this up, starting to see where we are. Let's look at something else at this point. 30-minute basis. Can we go higher on hourly velocity? Yep. We're not even maxed out right now, are we? We can go a little bit higher in hourly, can't we? And we are mega bullish on the daily. We have no new lows on the daily velocity. So there's some potential to go higher. Half an hour velocity is coming down right now. 15-minute velocity coming down right now. So I'm bearish on a 15-minute and a half an hour basis. But on an hourly basis, not so much. We could get one more pump to the upside. It's possible. So on a half an hour basis, I'm bearish. 15-minute basis, I'm bearish right now. I'm going to be looking and hoping for a dip buy down below into the Fed meeting. down here, or somewhere in here. I bet it's going to be 540.29 by the time we get there. Price target 540.29, 538.63. I do expect the hourly trigger to hold. When we get there, I do expect it to hold. And what's the last thing we can take a look at? Let's go look at Gamma. SPX Gamma. Initial rejection on the call wall at 54.50, right? We have new development to the upside. 5,500 is the new call wall if we can get above. So if we can get above 54.50, the call wall will become 5,500. It's at 174 million. Where is support on Gamma? Local support sits at 5,400. Right at 5,400. You see it right there? So when we go back to our chart over here, it's reinforcing what? It's reinforcing that there is a dip to, or the support, I should say, is somewhere right here. Gamma is saying if we go down here, it will be supportive, barring unknown unknowns to the market. Jerome fucking raises rates. Jerome walks out on the stage, pulls his pants down, hunches over, and takes a giant shit on the stage. Outside of that, this is where support is, right here. If you are a bull, unless we make a new high above 543.95, you are looking for a dip buy at 540.30 and 538.62. Sweet. All right. We got you guys all ready to rock and roll. Or what are my expectations for today? Roll it down to 540 at least, and let's fucking trade 550. Fuck it. Let's go. Let's wrap it up. Let's trade fucking 550. Let's get a good Fed share today. Hold on a second here. Sorry about that. I got to take my hair is like. Took a shower this morning and it's a little. You know, you like do your hair and shit, and then you leave it, and then you just gotta brush it out at some point. Look like a fucking weirdo this morning with my hair, so. All right. So we'll chase above R3. We'll look for a dip to the downside if we can catch a dip, and we'll take that trade when it comes to us. Let's bring that up right there. Let's make that a little bit wider. Take a peek at that and see what happens right here. Do you guys want to take a picture of this for your at home or something? Hold on. I'll put it on the big screen if you want to take a snip or something. You want to follow along like this, you can. And maybe this will help. I don't know if this helps or not. If you want to snip that. So you can be like, oh, I got to draw boxes and lines and shit on my stuff at home. There you go. Snip it. All right. All right, now we're gonna go back and address two things that Jimmy Berry brought up while we wait for the Fed chair. Oh. All right, so we're gonna look at something here. Let's see if this is what I want you to read. Ah, there we go. All right. So anyone that was wondering why I keep saying that we are already at 2%, even though we're not at 2%, right? How are we already at 2%? I'm going to post this for you in the chat. It's not behind a paywall. Spend 5 minutes, read through this entire article. Now, this is an op-ed piece, but Krugman does cite Fed data. And I want you, and he shows you the charts. So you can snip this and post it wherever you want, do the stuff, push whatever narrative you want on FinTwit, or on Webull, not Webull, what's it called? Wall Street Bets, or I don't fucking know. Our economics, our fluent in finance, wherever your place is out there in the internet that you like to shit post on. Stonk twits. And I want you to read this, please. That's an archived version of an article from the New York Times, an op-ed piece. Even if you hate the New York Times, that's all right, Ed. I don't like them either. Just read this. You can even just say, fuck Krugman, I don't like him. But he does cite fact in this op-ed piece. It's hard not to see it. It's hard not to agree with what he's laying down out there. So I'll leave it to you to read it. I'm not going to go over it here in the show. We've gone over this already in the show, so I'm not going to do it a second time. But I do recommend that you read that op-ed. It's quite important in the inflation fights, the economy fights, the employment fight, and where we actually are, where we are in the rate cycle. I guess I should raise that a little bit, right? Just to see here. Uh-oh. Bear's getting squirrely here. Bear's getting squirrely. Bear's sweating right now. Trading 542.73. Still no low for the Bears. They can't get it done. They need a new low below 542.36, and they're not getting it done. 12:44, they got 15 minutes left. They're not getting the new low in the half an hour yet. No bueno, Bears. No bueno. You know what else is fascinating is I've got let's see the JPM's CPI reaction function. 0.3% to 0.35%. JPM expected a 0.75% move higher. We blew that out of the fucking water. Goldman Sachs CPI reaction function, 0.31 to 0.34, 0.75%. We blew that out of the water. I think we're at 1.15 at one point or something like that. And I think it's even higher than that if you count the overnight and this morning. The percentage gain is even closer to like 1.5. So double expectations. Looks like the reports already, or the this rate decision's already known at this point. Bring that over there so you can see that better. No new low down here. Getting bullish. I smell a squeeze. All right, what else do I got here? Goldman's Rubner. Quote, I will send out a tactical bearish trading note in late July, August as investors degross into the elections. I have a ton of new data on this. However, I'm worried about a blow-off top higher first in July. Blow-off top in July. I don't think that investors are positioned for a further move higher in stonks. This would be a pain trade. Goldman's Rubner. I'll read it to you one more time at this point. I will send out a tactical bearish trading note in late July, August as investors degross into the elections. I have a ton of new data on this. However, I am worried about a blow-off top higher first in July. I don't think that investors are positioned for a further move higher in stocks, and this would be a pain trade. That was Rubner just a few minutes ago. Oh, fuck. All right, we're going to take a 5-minute break. Be right back with you guys in 5 minutes. I'm going to put on some talking head right now. I think I am. I've got audio issues today, so let's see if it plays.
Journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business.
I'm definitely not putting CNBC on. CNBC is out.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
Sounds official.
About our relationship than I do my wife. You know what I'm saying?
This is the show where we talk with big-time athletes and executives about the wins, the losses.
What up, John H?
Along the way.
This show is called The Deal.
The deal? The deal.
The deal.
That deal.
The deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Bloomberg Surveillance covers the latest in global markets and the political events that influence.
Squeeze them out.
Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Checking in on markets here because you do have an S&P 500 still up about 1.1% on the day. Absolutely flying. You can see all that green on the screen. After that CPI print just this morning, the NASDAQ 100 gaining some steam here, up nearly 1.5% on the day. The bid in the bond market is stunning. You have the 10-year yield down more than 15 basis points now. That bid has been accelerating ahead of that FOMC meeting. You are now watching the 10-year at 4.25 on the day. Remember, that is not only the lowest levels on the day, it is the lowest level since December as well. Now it's time for the Wall Street Beat with 2 interest rate cuts priced into the markets. Let's discuss the impact on real estate because PIMCO expects more regional bank failures in the United States because of a, quote, very high concentration of troubled commercial real estate loans on their books. There's a sense that 2 rate cuts might not be enough to fix it. Kane Anderson CEO Al Rabel joins me now. His firm has $35 billion under management. And, you know, of course, there's a lot of exuberance under the potential for at least 2 rate cuts this year. But the reality is we have seen rates go much higher in a short amount of time, and a lot of...
So if Jerome says no rate cuts this year, what happens to the market today?
Things still get...
Anybody?
...with 2 rate cuts potentially.
Anybody?
Pretty ugly. I mean, banks have record levels of unrealized losses on their balance sheet.
Canada Fed, this is setting up for a blow-off top or the mother of all rug pulls.
Bank balance sheet,
Up.
20% of that is backed by traditional office. So things could get
Moon, Gamma.
100 banks. Pre-GFC, we have 4,600 banks today. I'd venture a guess that we'll have 1,500 banks plus or minus 5 years.
No rate cuts, up.
There's going to be some pain. And I think, tangible equity is, bank balance sheets are challenged and tangible equity is in trouble at,
If Jerome comes out today and says you're not getting a rate cut this year, this fucking market's going to crater.
That most people don't
It's going to go to fucking zero, guaranteed.
show up in the next 12 months.
Well, it's just as that debt comes due and can't get paid off,
Tazo, I like you. I like what you're saying. I like what you're throwing out there, Tazo.
I think it presents a tremendous amount of opportunity for those of us who have capital and dry powder and who are prepared to take advantage of this dislocation. And I do think that we absolutely are. Yes, are we in a bottoming phase? Yes. But do I think there's a dislocation and a buying opportunity for the next 2 years? Absolutely.
Well, now that we have what we know today, this idea that inflation could be cooling, that rates might come down, how much do cuts start to help the market? And does it mean that we're seeing bottom right now?
Cuts are definitely going to help.
Dude, look at that. Even IWM fucking destroyed. Like this, I was like, yeah, we might get there in like Friday or something. No, we'll fucking do it today.
Asset deflation, exactly what we've been talking about.
Do it today.
Balance sheets are troubled. That said, it takes a while
God damn.
for cuts to work themselves through the market. So if Jerome Powell, I doubt that he cuts today. I said at the Milken conference last month that he would cut this month. I'm going to push that back a month. I think we're getting a rate cut in July, even though that's only a 20% probability according to the market. I think we get 2 to 3 rate cuts this year. I think we get 5 to 6 next year. I think the risk of a financial crisis and a contagion with bank failures outweighs the inflation risk. And now that he's been given some evidence that inflation has cooled, I think that he will take the step in July of reducing interest rates.
Let's talk about contagion for a minute, because that's something that people don't talk about a lot with an economy that's this strong. What becomes a bigger problem as time goes on at this level of interest rates?
Well, listen, we saw it with SVB, right? We already have greater losses in absolute dollars, SVB, Signature, First Republic, than we had during the entire GFC. So it didn't take very long. SVB, in theory, wasn't too big to fail, but it was the 24th largest bank in the U.S. That was going to be a contagion unless the Fed and the U.S. government stepped in, which they did. However, that is an easily repeatable process. And we, as I've said, many, in particular, regional bank balance sheets are in trouble today. So, in my view, Powell will want to head that off. He needed to see some evidence that inflation has cooled. He needed to show the American public that he understands the pain that they're seeing, at the gas station, at the supermarket checkout, et cetera. I think that came in today, and I think we're going to see an ease next month.
You mentioned investment opportunity, particularly in real estate. You have seen some real pain already in terms of...
Hey, if we're losing the stream, let me know in the chat.
Where's the greatest opportunity?
Can you guys comment in the chat really quick? I want to make sure I'm not losing the stream.
Private markets.
Well, I'll
just do a test. Someone type test in.
Opportunity both on the equity and debt sides of
Thanks. I appreciate it. That's good enough.
There is a rotation of capital that's happening into
I appreciate it.
Today.
Tess.
So we've been for a long time focused on demographically driven sectors.
All right, strong stream right on.
Demand, meaning that regardless of what's happening in the macro economy, these sectors continue to grow. Healthcare is one of those sectors, so medical office, seniors housing, huge opportunities today. I call it the trifecta. You've got demand tailwinds because for the next 20 years you have a dramatically aging U.S. population. You have supply tailwinds because of an illiquid credit environment, and you have a buying opportunity because structural leverage doesn't work for a lot of players in the market. So you have forced selling or highly motivated selling that's happening today. So that confluence of events only happens every 10 to 15 years. The last time we saw this kind of buying opportunity was just post-GFC.
What do you think about the private credit market? Because when you're saying that regional banks are still under this type of stress, a lot of your rivals have stepped into that market and said, hey, well, this is where private credit can play a role. At the same time, a lot of fear is brewing about a bubble. Too much capital, too little places to invest. Where's the balance?
I think there is an opportunity in private credit, and I think the returns today are outsized relative to where they have been, normally. There is a fair amount of cushion that is provided. So, I don't think it's all going to be roses. I think, it is important who you are investing with. and certainly there are going to be some issues, in some places. But the private credit markets at, sort of at 12 to 14%, which is 200 to 400 basis points above, market norms over the last decade, plus or minus. There is a fair amount of cushion even to shield from a downturn. So I think it's an outsized opportunity set, but the word of the day is definitely caution.
Yeah, what are the mistakes that people are making right now, you think?
Well, listen, I think one of my sayings is human nature is a very strong driver. People don't want to see negative things, and so human nature tends to, it's why we want to be.
Dude, Apple fucking hit the upside target too.
Not troubled.
I drew this out yesterday for Apple, and we nailed it. Like we're at the top for Apple right now.
Securities losses on their
218.19 was the expectation.
That's 16 trillion.
And I don't expect us to break above 200 until we backtest all that shit. Man, I wonder if we're gonna go down today.
Definitely strained at this point in time.
I got us hitting that target. Well, right here, I got it hitting right here.
And sort of clamoring for a rate cut,
but then I got us rolling down to then break above 220.
So I think,
We got to leave it there. We're hitting a hard break. That is Kane Anderson, CEO, Al Rabel. Thank you for your time. I'm Shonali Bassick. That does it for Bloomberg Markets. Stay with us. Just over an hour now away from the FOMC.
Anybody getting bared up out there today or no?
This is Bloomberg.
The world needs ways to reduce carbon emissions.
Not so much bared up from the news. I could expect like bullish news,
Like carbon capture.
but like sell the news. Bearishness, like sell good news.
Believe it or not, ExxonMobil and these solutions can help businesses
Like Jerome is like says everything we want to hear, and then all of a sudden it's just sell that shit.
Let's deliver.
Or a squeeze and sell maybe.
Markets move fast, and now you can too, with instant funding and fast trade execution at IG.
I wouldn't be here if I didn't start here.
I'm looking around right now. I've got a bunch of stocks that I'm looking at that I like.
And financial aid.
And they've all hit every fucking target's been nailed. So.
.gov/FAFSA info.
Not that I'm not bullish to go higher. Just there's a roll and then go higher. So I don't know.
Since the Citi Custom Cash Card automatically adjusts to earn me more cash back in my top eligible...
Not necessarily bearish, but
life's feeling a little...
like Apple in particular.
Earn cash back then. How you spend with the Citi Custom Cash Card.
Like some kind of back test, and then we eventually break above 220 to make our way higher.
Will be as we continue.
Or what do we do? Just squeeze up and say fuck it. Just squeeze up and then consolidate to make the move higher. I guess we got both the option A, option B. Option B would be ugly as fuck.
PM Eastern, Bloomberg. Context changes everything.
Option B. I figured that shit would take days, not fucking, not one day.
Covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is grow, and these things grow the overall industry. And
crypto as an asset class is here.
My thought here was that it would take. My thought here, we tag this. We did today. We tagged it today.
The biggest names in business.
But that we'd need more support to get up there.
Great question.
And we didn't. We're already up there.
Bloomberg, top expert.
And then I was expecting a back test to 186, but we're trading 215.
From the world of politics to the.
I don't think we're going back down there.
This is
215 to 186 would be death and destruction. I think they're going to push us over 220, and then we start making our way higher.
Live from
That's what I think. But I had a little flash of bearishness in me.
Welcome to the fastest show in politics.
Seeing that on Apple.
For the return of Donald Trump, a visit tomorrow. and the grand debate over potentially making the Trump tax cuts permanent. I'm Joe Matthew alongside Kaylee Lines in Washington. Welcome on Bloomberg TV and radio. We're just a day ahead on this one, Kaylee. It's going to be a big debate that starts tomorrow.
Yep, a meeting with first House Republicans, then Senate Republicans, and then a meeting with the business leaders, essentially, here in Washington. So he's going to be making a full court
business magmas and magnets,
including his tax agenda.
Did Tesla turn around?
We also have to talk about the news of today.
I didn't even check Tesla yet today.
Ahead of the Fed, which is just an hour from now.
Yeah.
Oh, fuck yeah, baby. There it goes.
30 minutes here on this Fed Day, CPI Day as well, and that means a busy one for the markets, Kaylee.
Indeed. So let's get a check on those now. Charlie Pellet has a look at that from New York. Hey, Charlie.
Yeah, Tesla's still bulled up. Tesla still has more room to run.
Dow, S&P, NASDAQ, all advancing right now. Records certainly for the S&P and the NASDAQ Composite Index. 1 hour.
Trading 179 right now.
Until the big event, the Fed decision, 90 minutes from now, the bigger event, Jay Powell's news conference. Covered on Bloomberg Radio.
What's going on with
stocks climbing to records as that broad
GME
spurs a plunge in bond yields. 10-year 4.25%, 2-year 4.67%. Equity markets ripping higher across the board.
Shit, GME.
59 now up 1.
GME's looking good too.
48 up 0.1%. Tech stocks, the big story. NASDAQ up by 308 points now, up 1.8%. NASDAQ 100 index.
You got the high end of the close yesterday. You didn't do it in cash market, but it was like 15 minutes later or something.
Surging now by 2.6%. Spot gold.
We'll let it count. And you got this one here at 11 a.m. So this is all pretty bullish here.
69 for a barrel
on GME.
Apple surging to a.
All right, I'll be right back with you guys.
Another 4.
Quick break, single potty.
Also at a record, Oracle shares up now by 12.2% after last night's earnings report. So lots going on. Recapping, stocks higher. S&P up 71, up 1.1%. Balance of power continues now. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lines.
All right, Charlie Pellet with a pre-Fed decision check on the markets on this CPI day. Pretty remarkable to see stocks at a record. But of course, Joe, interest rates are still high and they will likely stay high after the decision today. And often we talk about here in Washington the political implications of that. But there also is a fiscal question around the very high level of borrowing costs and an incredibly high level of debt. And as we get ready to see former President Donald Trump meeting with congressional Republicans tomorrow, addressing the debt, also addressing just the ledger, how much money's coming in versus how much money is going out, definitely going to be on the agenda.
Yeah, that's right. And of course, there's going to be a big drive for Donald Trump supporters to reinstate or make permanent, is a better way to put it, the 2017 Trump tax cuts. They are set to expire next year, Kaylee, and this is a big push in Washington. We're already hearing a lot about this, and it's at a time that frequently the concept of debt and deficits can be forgotten in a campaign season. But it's obviously an issue that Washington needs to get its arms around pretty quickly.
Especially when you consider the potential impact that could
According
have.
to Nikkei, the Bank of Japan will consider gradually reducing its Japanese government bond holdings at the two-day policy meeting that starts
how much
Thursday.
it would cost realistically to keep those tax cuts intact in 2025.
That's right. That important parts of the 2017 Tax Act expire at the end of next year, at the end of 2025. Those are not in our fiscal projections in the sense of, the taxes revert to the pre-December 2017 law and there's more revenue. So extending the parts of the Tax Act that expire would cost upwards of $3 trillion over 10 years and really closer to $4 trillion, including the interest service.
Today and get our special offer of
$3 to $4 trillion. We're talking big money here, and it's going to prompt a conversation about spending as well as taxation while we're at it, Kaylee, and that's where Kevin Brady comes in. With us at the table today, you know him as Congressman. We call him former Congressman now, former Chairman of the House Ways and Means Committee. Kevin Brady is now spokesman for the Alliance for Competitive Taxation, and we're lucky to have him just in time for the annual congressional baseball game. It's great to see you. Welcome back to Bloomberg TV and Radio. What a treat to have you at the table here. This is going to be part of your cause. So what do you have as a response when you hear about debt and deficits as an answer to making these tax cuts?
Yeah, so one, you have to ask the question, what happens if they don't extend it? So, putting a $3 to $4 trillion tax hikes on families, Main Street businesses, on American competitiveness has real consequences for lower paychecks, much slower growth in the economy, U.S. less competitive at a time China's super aggressive. You know what I mean? They want to dominate our industries and technologies. And so I think it's going to be crucial for both parties to find a way forward to extend those tax cuts, especially for those families, Main Street businesses, and our competitiveness. You may remember the reason we did it was that for a decade before 2017, the economy was slow growth, less than 2% for a decade. Paychecks have been flat, and every other month we saw another U.S. company move overseas. So we had to modernize the code in a big way, lower rates, but we did it in such a way we created code built for growth of jobs and the economy and paycheck. We wanted to make sure we were the desirable location for new plants, innovation. We did that. We wanted one of the most competitive economies on the planet. We did that. And as a result, paychecks, the thing I think I'm proudest of, in the first 3 years after tax reform, paychecks, inflation adjusted, went up 9%, the highest level since we began keeping records. So people were getting ahead in a big way. That's really the legacy of those cuts and why Congress has to find a way to extend those or make them permanent.
But people were getting ahead. At the same time, the deficit was growing. So if you, as you say, businesses and consumers actually need these to stay in place, how do you make it fiscally responsible?
Yeah, so the good news is there's ways, and here's why. People remember the tax cuts is costing $1.5 trillion, even though we've seen record revenue. Like corporate rate revenue today is higher at 21% than it was at 35% because of the growth. So we've seen good growth. But bottom line is the actual cuts were $5.5 trillion. We paid for $4 trillion of it. Reforms to lower the rates, to modernize the code, and to grow the economy in a big way. So lawmakers, as they extend the tax cuts, will also extend the reforms that help pay for it. That won't cover all of it. It's a good, solid step. So depending on the party, depending on in an era where deficit and debts really matter, both parties are going to have to decide. So do we pay for all of it? Do we pay for most of it? What does that good policy look there? And so they're going to have to be looking at similar type reforms as we did in 2017 going forward for that very reason, to make sure we're not adding, significant amounts to the debt.
But you're sitting down there in Texas looking up at this crowd now. And we can hardly figure out a budget.
So as a reminder that you can trade the FOMC with us starting at 1:15 p.m. Eastern Time. This is hosted by our very own Tony, who will go over the fundamentals ahead of this release. The link is on the feed for all those interested.
I do, and here's why. I think there's a middle class in Congress, people you don't see or hear about often. They are very solid, trying to do the right thing, serious lawmakers, and they're going to be the ones to be putting these packages together.
Are they on both sides of the aisle?
So I believe there is. I believe there is, and I think that they can, because sort of like 2012 when we saw the Bush tax cuts expire, both parties had a lot at stake, in that, and they do again in 2025. The thing is, my point is, don't just extend or make permanent, keep improving the tax code. We can be more pro-growth. It can be simpler, especially on small businesses. Things have changed, because of China is so super competitive. AI has changed things. Innovation should be, especially for our U.S. companies, the country that wins the innovation race wins the future. And ACT's top priorities are keep America competitive, make us the most desirable place for those new plants to innovation, keep incentivizing innovation in the U.S. And I think those are policies both parties, can embrace.
Well, it's going to be one party, or at least the majority of the parties in both chambers, meeting with Donald Trump when he's here in Washington tomorrow. To what extent is he already influential on this conversation, knowing that there was a bipartisan tax bill that passed the House with massive bipartisan majority that ended up going nowhere in the Senate? And some people were telling us it's because it's an election year. And if you expand the child tax credit, potentially Biden gets credit for it. It becomes political. I wonder what you think of that narrative.
Yeah, so I think, President Trump's very influential, certainly among the Republican Party. These drove his economic agenda that is so popular with the American American people. So he's got a big stake in extending that. And the corporate rate cut, for example, that drove so much of the paycheck wage growth was his signature achievement. So he's going to play a big role. I think some of the dynamics of this year's tax bill will still be front and center in 2025. You know, you're going to have businesses, you know, Republicans that want the middle class cuts, the small business cuts remain in place, and want America to be super competitive. Democrats are going to want a child tax credit that looks like the COVID era credit. They're going to want to defend the green energy subsidies, Inflation Reduction Act. So you can already see sort of the battle lines being drawn. But 2025, with the prospect of $3 or $4 trillion of tax hikes, it's going to focus leaders in both those parties, tax writers, who are already beginning their work.
We're still waiting for the tax code to fit on a postcard. Wasn't that going to happen?
You know, I tell you what, in the House, we did exactly that. Our version was 13 lines on a postcard that 90% of Americans would use to file. I still dream about that. Because,
I'm sure there are many others.
Can you imagine you and I looking at a postcard and saying, this is how I'm taxed, and more importantly, that's how my neighbor is taxed. There's real power to simplicity. So I'm, you know, if you ask me things I dream about, I wish we could have actually achieved, you know, the postcard, and that fairness from that is certainly one of them.
On the subject of what could be dream and what could be achievable, we had Donald Trump over this past weekend in Nevada floating no taxes on tipped income.
Yeah.
Do you think that is actually something workable, knowing he would need congressional approval to actually do that in a second administration, or do you think that was just kind of an idea that was thrown out there given the audience?
No, I think it doesn't surprise me. And here's why. Because during tax reform especially, you couldn't be at the White House that he wasn't asking, what are we doing for the little guys? What are we doing for the blue collar workers? I mean, that is part of who he is. I don't know tons about the tip thing, but here's, so full disclosure. I'm one of those people, I want fewer tax provisions for some, lower rates for everyone. I think that's the fairness here. But I think there's two impacts. One, if you tax less of something, you get more of it. So I think there'll be more wages sort of redesigned on the tip model. Secondly, those are industries that really have trouble hiring people and keeping them. You know what I mean? Those service industries. So you may see more young people. I was a waiter and a bartender. I've lived that tip life as well. And so you may see more people drawn to some of those service industries that traditionally, you know, it's been hard to cover those tables.
That's for sure.
Yeah. All right. Well, sir, great to have you here in our studio. Thank you so much for joining us, Kevin Brady.
At the ballpark tonight.
Yeah, good day. It's going to be great.
Indeed. Beautiful night here in Washington.
Absolutely.
Former chair of the House Ways and Means Committee, now spokesman for the Alliance for Competitive Taxation. We appreciate you joining us. We want to turn now to our political panel as we look ahead to the perhaps non-tax related discussions that will be happening on Capitol Hill tomorrow between former President Trump and congressional Republicans. Rick Davis and Jeannie Shanzano, our signature political panel contributors here at Bloomberg, are joining us now. So, Rick, do you think that there's actual items on the agenda for these meetings, or is most of this about optics and the show?
Yeah, well, first of all, you can't get away from the optics in the show, right? We're right in the middle of a presidential contest, and I think that part of what Donald Trump's message is going to be is, hey, our boat floats with me at the top of the ticket. Anybody who thinks that they can do better is crazy. Everybody needs to rally around my candidacy. It's going to be all about how the top of the ticket is going to drive the outcome of the election. And that's the political message. I think that when you get into substance, I think that Donald Trump's going to make sure nobody goes out there with an agenda that somehow puts either his campaign in a bad light or the Biden administration in a good light. Certainly the untold message, he won't say this specifically, I would assume, but you never know with Donald Trump, is that don't do anything that's going to cause me any problems between now and November. That is probably the most important thing, because there are various elements of the House and the Senate who have agenda items that could cross-pressure his campaign, and he doesn't want any of that stuff happening. So it's almost like, play along with my campaign, do what I tell you to do. We're all unified around me, and don't do anything between now and November that's going to cause a problem for my campaign.
Jeannie, you just heard the pitch from none other than Kevin Brady, who used to chair the House Ways and Means Committee, with a strong argument on making the Trump-era tax cuts, as we call them, permanent. This is going to be a big debate that makes its way onto the campaign trail. What's Joe Biden's answer?
Well, first of all, I love the 13 lines. I remember a good postcard, and I love that. So I wish Kevin Brady would come back and fulfill that. I think what is going to happen, or what should happen in a serious discussion, is to look back and look at the reality of Donald Trump's record. You know, he promised cuts, and he delivered those cuts for billionaires, for the very wealthy, and for big corporations. He reduces the corporate income tax to 21%.
First
He's
repo
the
operation.
first president since Herbert Hoover to leave with less jobs than when he came in. And of course, he had the pandemic to deal with. So I will cut him some slack on that. And the budget deficit has soared under both him and Joe Biden. And we're now over $3 trillion. So, you know, I think he likes to hype his record, but I think real serious questions have to be asked about both his record in the past and what he wants to do now. If he wants to grow our military, for instance, how is he going to do that if he is cutting revenue? You know, in a way, this isn't complicated, right? If you're going to spend more, you got to tell us what you're going to cut. I don't suspect we hear any of that tomorrow, by the way, but I think those are the serious discussions that have to be had. And I think on Joe Biden's part, he's got to say, we haven't reached where we should. We still have very high costs in this country, but we are moving in the right direction. And I am going to take on all of those corporate billionaires and the corporations that Donald Trump has been delivering for and continues to promise to deliver for if they give $1 billion to his campaign.
Well, Rick, to Jeannie's point on if you are going to reduce revenue, you also need to reduce spending. We all know how big the slice of the pie is that you can actually reduce, because the mandatory part of the ledger is just so much larger than everything else. There's very little discretionary that you can actually cut. The problem is when all of that, or a big chunk of that, is entitlements, neither Joe Biden or Donald Trump can touch that politically, right?
Well, certainly they're not going to touch it between now and Election Day. They've both been very clear about their lack of interest in reforming entitlements. The real question is, both of these guys, regardless of who wins, this will be the last job of their political
77
career.
counterparties take 447, spot $574 billion at the Fed Reverse Repo Operation.
In order to reform some of our fiscal house, we have got to start to get these entitlements under control. Because as you point out, Kaylee, I mean, there is no such thing as cutting a budget without touching the entitlements. The rest of it is just optics. And so that's the question is, do they have the political wisdom and courage in the last 4 years of their political career to try and put the country on the right track when it comes to this excessive entitlement spending that's going to bankrupt the country at some point if it's continued to go unchecked?
Our great panel, Rick Davis and Jeannie Shanzano, our signature panel on balance of power. Many thanks to both of you for helping us distill all of this. We're going to be talking a lot more about it, of course, tomorrow when Donald Trump makes his visit here to Washington, D.C., meeting with lawmakers on the House and the Senate sides. And coming off of our CPI data this morning, Kaylee, we're looking ahead to special coverage here a little bit later on this hour as we prepare to hear from the Federal Reserve. Two big shots today on the economy in Washington.
Yep, first inflation data, then a decision and a press conference from Chairman Powell. And we're going to talk to the White House about these things coming up. Heather Boucher of the Council of Economic Advisors will be joining us in just a few minutes right here on Bloomberg TV and radio.
The world needs ways to reduce carbon emissions,
especially for heavy industry. We're working on solutions in our own operations,
like carbon capture and clean energy from hydrogen.
So who are we?
Believe it or not, ExxonMobil. And these solutions can help businesses like yours.
Or yours.
Or yours.
Heavy industry with low emissions. Let's deliver.
Markets move fast, and now you can too, with instant funding and fast trade execution at IG.
Building a home, throwing in a line,
your truck to life. Real truck.
Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Top names at the Fed are on Bloomberg.
The way I look at it is, we have a restrictive monetary policy in place. It has shown up in terms of moderating the labor markets. They're becoming better balanced.
I do think that our new steady state is likely to be higher than what people have known over the last decade. I think that it will take quite a while for us to get all the way to 2%, but I do think we'll get there.
Nobody covers the Fed like Bloomberg. Context changes everything.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Invest, don't trade. Invest for the long term, i.e. when markets are challenged, don't get spooked. Don't get involved in investment hobbies. Investment hobbies are generally not profitable.
The names that move markets are on Bloomberg.
It is President Biden's top priority to bring down the cost of living.
The United States' ability to spend without constraint is not unlimited.
We're in a very unusual time, and so the adjustments are taking place, and it's running through the economy.
We do need more innovation, more investment, single market and capital market union, and a relevant trade policy.
Bloomberg. Context changes everything.
It's 1:21 on Wall Street. We do check markets all day long here at Bloomberg. We're looking at records on this CPI Wednesday, a Fed Wednesday as well. S&P now at 54.37. Stock market pushing higher. S&P right now up 1.2%. We've got NASDAQ up 323 points, up by 1.9%. The Dow up 0.2%, up 66 points right now. Perhaps the big stock market story, the surge in the Russell 2000, up now by 2.6%. Bottom line here, stocks hitting records as a broad cool down in inflation spurs a plunge in bond yields. 10-year 4.26%, the 2-year 4.68%. Spot gold up $22 the ounce now, $23.39, up by almost 1%. West Texas Intermediate crude up 1%, $78.68 a barrel. Apple has overtaken Microsoft in market cap on an intraday basis. Apple shares at a record, up another 4.8%. After earnings, Oracle at a record up 12.7%, and a deal in the energy industry to tell you about. Oil producer Matador Resources buying assets in the Permian Basin from a portfolio company of NCAP Investments for $1.9 billion in cash. Matador down now by just about 0.8%. Again, recapping, minutes away from our Fed coverage, S&P up 63, a gain there of 1.2%. Balance of power continues now. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet up in New York. Thank you so much. I am Kaylee Lyons alongside Joe Matthew here in Washington, where we're just as busy as New York is today with this double dip of big economic events. A Fed decision coming up in just over half an hour, Joe, after cooler inflation data this morning. On the headline monthly CPI figure, we get a 0.0%.
Yeah, kind of amazing. Markets love it. White House likes it, but treading carefully, as we see in the statement here. Prices are still too high, writes the statement from the White House, but today's report shows welcome progress on lowering inflation. Let's go to the source, and a great opportunity for our special coverage begins here on today's Fed meeting to speak with Heather Boucher, a member of President.
What do we got here?
Of economic advisors. She's with us.
So I guess all right. So
It's
I just got off the phone with a developer, one of our devs.
Is clear, as I read at the outset.
And I'm not going crazy.
I also wonder if you're thinking inside about how far.
I swear so I woke up this morning, right?
In so many different ways. You know, I think about the economy that the president inherited.
I thought I'd taken a crazy pill.
Got unemployment down.
I thought I took a crazy pill this morning. I'm like, what? So this morning I woke up, right?
Prices come down by about 60%.
I had
good news.
We listed all the things that were down.
The flat.
So I had Thinkorswim down.
So this is certainly been giving.
I had Streamlabs going haywire.
And is good news.
Chrome going haywire. Windows going haywire.
Saw yet another month of wages outpacing inflation.
And then this was the spicy one.
For the 80% of the workforce reduction in non-supervisory employees.
Yeah, Thinkorswim went crazy. Streamlabs went fucking bananas.
That's great news.
Chrome went bananas. I couldn't log into Discord.
Well, Heather, even as we talk,
I was like, what the fuck is going on? This is going on in
still is a bit
multiple computers.
That shows some
So I've got these things all
shelter prices
connected.
Up 0.4
like in parallel.
Equivalent rent. Similar.
But I'm going, what the fuck is going on here? What's happening on one computer, that's one thing, but it's happening on multiple computers.
Members of the Democratic Party, like Senator Elizabeth Warren.
So I'm scratching my head this morning. I swore I took a crazy pill. I shit you not.
To buy a house.
And then
can you be confident?
I logged into Canva this morning.
Shelter price pressures are going to come down.
And I logged into Canva and I started disconnecting from Canva. Like Canva was down. And then I just found out that our website went down, which is hosted on AWS. There's no local hosting. We pay for AWS. So the website went down today too. Too many coincidences. I shit you not, I thought I was taking crazy pills this morning. I was like, what the fuck is going on? Did the cats walk all over and hit hotkeys or something? Like walk over all the keyboards? What's going on here? Did my wife come in? My wife's like, I was in your office this morning. Something was wrong with the computer, so I went in your office. I'm like, oh God, she fucked it up too. And then I just got on the phone with Dev, and he thinks there might be solar flares or something happening. So there's something going on out there. I want you to know that. If I lose the broadcast today, it's not me. It's like something with either AWS, across the internet, solar flares. It's something. It ain't me. So I'm not going crazy at this point. It wasn't me. And not only that, so I'm working on this stuff in the background on my end. And I'm like, this shit's not taking on Streamlabs. I'm resetting all this. And I still have problems right now. I'm still having issues with not being able to hear certain things in my monitors. Also, I want to point out to you, be very careful. I shouldn't have even written this in to you. I shouldn't have drew this in because there's a possibility of a trap in here for bulls. Just note that there's a likely trap in here due to the presser at 2 the press release at 2 in the 2:30 presser. Now, I'm going to lay out for you, if you've never been here before, what to expect. You know, I think there are people here that have not been here. Someone mentioned earlier, you're going to cover the FOMC. Welcome to the show. That means you haven't been here for prior FOMC meetings. This is kind of a big thing that we do around here, so I appreciate you being here. So this is kind of how it goes, with us at least. I will post up for you, or we're going to switch what we're looking at, and you're going to see Jerome Powell speaking. Well, first, what happens, I should rephrase that. At 2 p.m., I'm going to have a news squawker that will read to you the Fed press release. And if any of it is hawkish or dovish. I will also read that to you, that release. I will go through it page by page, and if I see anything sketchy in there, you'll have a news squawker and myself reading to you hawkish or dovish. You can ask anybody in this chat and I go down the fucking rabbit holes in this shit. Like I do. Like I read it all. I've been doing these Fed meetings for years. So I get a decent handle on what's hawkish, what's dovish, what's expected, what's not expected, that kind of stuff. That's at 2 p.m. It should give you a moment or two before the market reacts. Usually give you a moment or two to wait to take a long or to take a short or whatever that is you're going to do. And I'm going to show you where the levels are for the downside move and the upside move and what needs to hold and what the tops are and all that kind of stuff. And they are flushing you right now already. You see that? They're flushing you right now. So that'll be between 2 and 2:30. When we get to 2:30, the screen that you see here, I'm going to change. And, well, you're going to get a change right now down below. And what I'm going to put up for you down below is I'm going to put up the 10-year yield, the DIX, and you'll have SPY up here. I think the 10-year yield and DIX maybe are good enough. If you want, I can do HYG for you maybe. But then we'll switch to a new format, and that new format will have Jerome Powell. It'll have a news ticker coming down, the DIX, SPY, and the 10-year. Look at that, blooding you right now. It was a trap. We'll listen to Jerome speak, and I will not interject unless there's something said that's material. You'll hear me say something to like, this is material, this is hawkish, this is bad, this is good, and that kind of stuff. Now, there's a few things we're going to talk about before we get to 2 p.m. It's 1:31 right now. We have 29 minutes before we get there. Now, normally, if we were on a low, we have a high probability of squeezing up into the presser at 2 p.m. We're on a high. I do not see us squeezing up before 2 p.m. I don't see it. I think we go down. Because of where we are in price, I would have a hedge in the market here. And you can see they trapped you, right? They've already trapped you inside before we even got there. I did say something to you, there's likely a trap in here, but you guys got the picture anyways. Okay, so there's a trap in here. So they did trap you. Get rid of this. I want to show you where real support is in the market right now, okay? Just so we all have our bearings here. Where is real support in the market? Real true support, you're not going to like this, is way down here. I gotta tell you guys this because you never know what's going to happen, right? Just like this morning, how high we went, you never know what's going to happen. So I just want you to know that real support is right about here. You could count real support as right here. As a matter of fact, this is real support right here. 526.99, 526.50. I need you to understand that. That is real support. Okay? And this is below the gamma flip. The gamma flip is roughly right here. Far away, right? Far, far away. You want to see this on a 30-minute basis, maybe? It's like real support's way down here. Gamma flip's way down here. That's the real support, believe it or not. Far away. So be aware of that. We could plunge easily down there on hawkish Fed. Like, wouldn't even blink. Jerome at any point says anything, anything in the report that we're not getting a rate cut this year, any hawkishness, all that shit's coming back. I guarantee it. Guaranteed. Blink of an eye. I'm telling you. So be warned. That's real support. Right down here. Now, into this FOMC rate decision, it would not be a shocker to see, even if it's bullish, to see at some point today a trade down to 540-ish, even if we're going up. Would not shock me. Would not shock me for 30 seconds, a minute to blast down. The next thing I need you to understand is, I already told you about sell the news, right? Already told you about that, sell the news. But I also want to tell you something else. We have event vol crush, volatility crush, event crush. This is when they crush the options chain, they reprice the options chain. And that's also, in that function, you'll also see squeezes get sold before we get to targets. So you can see a squeeze up here, failure, they reprice. Squeeze up here, failure, they reprice. Squeeze up there, and it's right before you get there. It's never there. You don't actually tag the expected move. They drop it before we ever get there. Okay? Would not shock me to see a move that's like this. Blast down to the hourly trigger, even on a bullish, dovish move, and then boom, failure, boom, failure, boom, failure. Repricing all along the way, and you're right, but you're wrong. So just be aware of that as well, okay, as we head into the 2 p.m. hour, the 2:30 hour, and then the 4 p.m. hour. What else? What else I got for you? If you are trading this today, this is not financial advice. Number one, not financial advice. Number two, if you are upside down in a position, this would just be from my experience on Fed Day. I want to tell you this on Fed Day, okay? Let's say you're upside down in a position, right? Let's say you're long here, and we blast down. You can DCA, higher strikes, whatever you want to do. But I'm going to tell you one thing. It's either going to continue down and you're going to burn everything, or it's going to swing back up and you're going to get paid. The point here is don't be trigger. I don't trigger stops when we do this down move, or if I get caught in a down move on a day like today. I won't cut here. I just stay long and let them burn to zero, or wait until they come back up so that I can even get out of the trade. Just get me out of the trade at this point. But stops are dangerous on days like today. What else can I say about today specifically? Strangles and straddles are better. Spreads are better here. Selling calls maybe are better here. Selling calls are gorgeous here. Sell 460C, done. Sell 455C, done. For Friday, yes. Spreads are better, so you don't get nailed with a volatility crush. Okay, so spreads are always a better friend to you. Up or down doesn't matter; they're always better in these events. What else I want to tell you about 2 p.m. today? I think that's it. If you want to know what I think happens, I already described what I think happens. I think we plunge. I think we plunge down to the hourly trigger, and we might see a little bit more upside. We may see more upside to 545. Possibly we can get to 550. Possibly, depending on how dovish he is. If he comes out as hawkish, we will trade that down below 526. I guarantee it. If he's super hawkish, we will go below that 526. We'll trade 515. So depending upon what he does today, that's what I think will happen. Do I think we get the hawkish or the dovish Fed president?
An early heads up now, 20 minutes away from the top of the hour, where we do see the release of that US interest rate decision alongside the FOMC's rate statement and the much anticipated summary of economic projections as well. So for the consensus, the interest rate is expected to remain unchanged at 5.5% at this meeting. So attention again will be turning to that rate statement and that SEP, as well as the subsequent press conference from the Fed's chairman as well. We're looking for clues on the Federal Reserve's thoughts on the future path of interest rates for the US. So if we just look at some commentary from some investment banks here, then Wells Fargo write a piece noting that the FOMC members again are going to keep rates on hold at this meeting. A committee widely expected to keep the Fed funds in the bounds of 4.25 to 4.5%, a level which has been held at now for nearly 1 year. So Wells Fargo noted that the focus therefore will be on this SEP. Most members expect 50 basis points of cuts or less. However, a dovish outlier pushed the median expectations for rate cuts this year at the last SEP up to 75 basis points. So meanwhile, the longer run interest rates from estimates inched higher, surpassing 2.5% for the first time since March 2019 at the last SEP. So Wells Fargo in this meeting, they say their call is for the median 2024 dot to lift to 4.875%. They note that that's reflecting expectations for 2 25 basis point cuts this year instead of 3, which was the median in the last summary. That said, Wells Fargo noted they would not be surprised if the median projection calls for just 1 rate cut. This morning's employment release, this was released on Friday, so they're referring to Friday's employment release, was chock full of mixed messages that are unlikely to sway the committee one way or another.
That was important, that last little bit there.
Wells Fargo note that any new inflation data referencing the data today will be instructive on the trend direction of price pressures. They look for an incremental improvement in the core CPI constituent, which we did see earlier this session today.
You don't want to hear 1 rate cut this year.
Also note that their base case remains for just 1 rate cut to occur in September.
We priced in 2 rate cuts today. You don't want to hear 1. You do not want to hear 1 rate cut. Do not. That's no bueno. Yeah, you got it. You got it. They will. They will send it down. You want dovish Fed. Dovish. It doesn't matter if we get the cut or not. It doesn't matter. We don't care if we get the cut. We want the talk. Talk is what counts for today. You get talk from the Fed that you ain't, like if Jerome comes out and he's like, you ain't getting more than 1 cut this year, I guarantee it. This fucking shit's going to plunge. Guaranteed. You want dovish Fed today. For the where price is right now, we're at sell the news right now. I'm going to warn you, we are at sell the news here, so you better get the dovish Fed. If you're a bull right now and you're long here, you want like Jerome Powell, bulled the fuck up, period. Or they're going to plunge this fucker right to the depths of hell. Guaranteed. Guaranteed. I assure you. Yep, you need Victory Lap Jerome. That's what you need. You pretty much need, if you're a bull, I'm going to tell you what you need today. You need to hear Jerome and the decision say some specific things. We have have basically completed our operations on everything except for unemployment. And we also want to let employment improve. That's what you want. And we expect 2 rate cuts this year. That's what you want to hear. If you don't hear that today, if you don't get Jerome with the fucking green tie, I saw one of you guys earlier mention the tie. You don't want to see the purple tie. You don't want to see the red tie. You want to see like the blue-green tie, no yellow tie. We won't. I'm telling you, we won't. We are priced in for 2 cuts as of today. So you don't want to hear any of that shit today. I think you're gonna get that. I think we've talked about this in the past for the reasoning why 6,000. We can make it really simple. There's an idea that the market's going to crash. We're at the end of a debt cycle, and the stock market's going to crash, likely in 2025 or 2026 at the latest. So the Fed needs to get the price of the market up for that crash. They don't want it going to 0. Sorry. It's up and to the right. That's what it is. So there's a thesis there, just a basic thesis. And that's based on known cycles, known economic cycles, known housing cycles. We're pretty close. We're fucking close, dude. We're at a 20-year housing cycle coming up in 26. So there's an idea here that you put a buffer in, or that they ramp it up into that event. We did it in 2001, right? We did it in 2000, 2001. We did it in 2007, 2008. We did it in the teens up into 2019, didn't we? So if they're thinking that's going to happen, they're not going to do it at 3,500. There's a bunch of reasons why we went up, but there's actually some major reasons why we went up after 2023. But we're at the end of a debt cycle, so I don't think he's going to be that hawkish. But if he is, or if he's neutral, watch the fuck out to the downside, okay? Into 2 p.m. today. I will also post the full minutes, or not minutes. I will post the presser in the chat for you if I have time, so that you can read it as well. Maybe you guys in the chat right now, it's 1:47. We got 13 minutes left. Maybe you guys can give us your ideas on what you think happens as we approach 2 p.m. Why don't we do it like this? I would ask for a poll, but I don't know if anyone can put one up for us. We can just do it in the chat. Tell me in the chat. You can answer any way you want, but you can do it like down then up, down, up. So you just say up or down, or you say down up or up then down, whatever you want. Let's get your input. I appreciate and trust you guys. Just kidding. When the chat is closed off, I trust you immensely. I'll be honest. I do. You guys are really good. But drop in the chat what you think is going to happen. By the way, if you're watching right now, the chat is open. If you're on YouTube watching, you just subscribe. It's free. Click the button, subscribe, and you can chat all you want. And I would appreciate if you guys could like this video. If you're on YouTube specifically, try to hit the actual like button. I'd appreciate it. This stream is free. I don't have any sponsors. I've never taken a sponsor. We've talked about taking sponsors, but I have never done it. So I'd appreciate if you could like the stream, maybe make a comment, not in the chat, but down inside of the video. Just say, I don't like you, Captain Jim James. Captain Jim James, you're the worst ever. You've got ugly feet, Captain Jim James. I don't know, whatever you want to say. If you hate me out there, just say I hate you. Not in this chat. Do it in the chat that's below the player. It's like permanent. It helps with the algorithms with YouTube. Also, YouTube is delayed, natively delayed. I think if you want real time, you watch us on Twitch. Twitch is real time. I've got a fucking fiber cable, commercial cable running into my office here. It is literally, and I compress everything and repackage it and send it to you. I've got multiple computers hooked up to each other so that I can get you all kinds of cool shit. So like Twitch is delayed like milliseconds. Maybe the worst is, your end might be slower, but on my end, if you've got fiber, it's like 2-3 seconds real-time delay. YouTube can be like 14 seconds. If you're like, fuck you, Cap, I love YouTube. Down in the cog wheel, you can click that at key moments and speed up playback times 2. I'll sound like a weirdo. I do already, but I'll sound like a clown.
Medium forecast sees no change.
But it'll bring you into real time for about a minute or two.
And the latest summary of economic projections as well.
One more thing. It's Fed Day. You don't have to have a fucking position on Fed Day.
The U.S. economy has proven
you can trade the reaction.
In the face of
trading the reaction is always preferable on shit like this.
Particularly related to low-income households.
If we moon, you can sell it. If we crater, you can buy it. So trading the reaction on a day like today is better. And here's another thing.
Are rising sharply, while a record 10.5% of credit card balances are only receiving the minimum monthly payments.
And here's the last thing. It's so much easier to make your money not on these days. When the market's predictable, it's fairly easy to make money, right? Yesterday, I made one trade. I made 100% trade yesterday. Easy. Easy fucking money. Days like today, it's a guessing game. Anything can happen on a day like today. Why would you ever put that extra risk on yourself to lose? So not trading on a day like today is a win. Wealth preservation is a win. Paper trade it. Paper trading is great. I recommend everybody have a paper. Matter of fact, we're developing a paper trader right now for that reason. A free one. A free paper trader for you guys to use. So it's okay not to trade days like today is my point. Don't feel like you have to have skin in the game or you got to like tell us, you got to like have bragging rights in here and be like, hey, I was this and I was that. The last thing that I would say to you as we come into this moment here, we got 8 minutes left. Do not trust anybody in this fucking chat after it happens. Don't be like, you'll see people, if they're losers, they won't say anything. Only the winners are going to say something. So if somebody wins, it always seems like you're losing and they're always winning. It's because they won. People that don't win, they don't say anything. So like, don't trust the chat after a move is made. Make sense? Don't feel bad. Be like, all these people are winning. I'm always a loser. There's a whole other group in there that didn't win. So, be careful what you read sometimes after something happens. Would be the last thing I would have to say to you about this stuff. It's a good day to just hang out. We'll drink a whiskey or something together at the end of the day today for all winners or whatever. If you want to know what I think we plunge and then we go up. So that's my take. Don't trade based on that. Don't be like, oh, Captain said it was going to go down fucking the hourly trigger. We just squeezed all the way up. Fuck that guy. Don't be basing your trading off what I trade. You trade your own trading, and you are responsible for the trades that you take. Not me, not your partner, not the fucking guy you meet here in the chat. You are ultimately responsible for your own trading. So, and take trading like that. Be serious. Take it seriously as an adult. So, that's what I think happens. Don't trade based on that, though. I think we got a dip. And I'm going to say that I'm going to repeat this, too, because I've had some people question this over the past week. I am not a fucking chaser. As a matter of fact, I talked to David AMS this morning while the stream was down, and him and I were having a conversation this morning. I'm not a fucking chaser, and neither is he. If the setup isn't there, I don't chase. Even if I'm bullish. I'll be like, nope, I want to pull back down to this number for me to get involved. And I recommend that to anybody. You can be bullish and bearish at the same time. I'm bearish for a pullback. I didn't get one, right? So I don't get to trade. I'm not a chaser of price, never will be. And I have chased price, and I usually lose when I do. So that's one more thing to talk to you guys about. All right, so outside of that, We're going to await the press release here in a few moments. You're going to hear the squawker talking in the background. And then after the initial excitement, I'll switch over to a different format so you guys can watch Jerome Powell, blah, 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 and all that kind of shit. Do you have any questions before the press release here? It's good to tell people when you lose, too. Losing sucks. I lose on this show. I fucking get smoked. And that's part of why we do that here, right? I want you guys to see not just the wins, but the fucking losses. And they suck. Someone mentioned that in the chat just now. It's okay to tell people when you lose. You guys are retailers.
See the release of the
Get the whole fucking world against you.
Medium forecast sees no change at 5.5%.
You guys have everybody against you. Nobody likes you. Professionals hate you.
Rate statement and the summary.
Pure contempt. You should be nice to each other.
The focus will lay in this release.
If you lose, say something like, oh man, I got fucking smoked. That's the only person that cares about you, your fellow retail trader.
They say that money market forwards are pricing in 2 rate cuts.
CNBC hates you.
Unicredit
like professionals hate you. They all hate you. They don't want to hear that, but that's true. All right, so we're going to do what? The DIX, DXY.
Softens enough by late July. Markets could easily price in 3 rate cuts this year, and that this is Unicredit's baseline as they expect a more pronounced cooling in the labor market than many other analysts. They say that should the Fed be unable to cut rates in July, the bar for markets to price in 3 rate cuts this year would rise considerably. Easing expectations are more pronounced for 2025, with 4 cuts being priced in. Till the end of 2025, Unicredit's forecasts are below forwards, and this suggests scope for a strong performance, especially at the shorter tenors. Again, just according to Unicredit.
DXY, the Dixie baby. Okay, Dixie. Also of note here today, I normally don't do plugs, but if you ever want to join what I think is one of the best trading communities out there, you can always join us. You can always join our community. We stream Monday through Friday, 9:30 to 4 p.m. We have a very active Discord with professional traders, actual professionals in there. They're not paid. So if you're watching out there and you're like, you're not supposed to have that, as long as I don't pay them, they're fine. A 10-year yield, right? There's the 10-year yield right there. 10-year yield. You can join us or figure out how to join us by joining us at tradethetrigger.com. We'll just write 10-year yield. We got some really cool stuff in our Discord. We've got all the premium bots. We've got Unusual Whales bot, Trady Ticks full suite, all that shit. Just that alone is really fucking cool. I think it's $32 a month. You get a market brief from me every night. It's not always right, but I do take a position. I don't give you the bull, bear, and the middle case and not tell you what I think is going to happen. You get my thoughts every night of the week. I cover SPY, Qs, IWM, and then if you're a pro trader, we cover everything. Metals, commodities, you name it. You name it, we cover it. Whatever ticker's running right now, Tesla, Apple, whatever the big sauce of the day is, NVDA, whatever. You get those supplements twice a day. You also get at the basic membership, you get twice a day updated, manipulated charts with the triggers and velocity on it. You also get there we go. You also get the pivot points, and then we have a bunch of shit development right now. Like crazy development going on in the background. So we got a bunch of tools coming your way here really soon. Gamma suites, CTA stuff.
1 minute remaining. I'll be leading with the U.S. interest rate decision.
Here we go. You ready? 1 minute. Market's drying up right now in Bookmap. Waiting the decision. Good luck out there. I got a fuck ton of puts on, by the way. I do. I'm not going to lie. They're so fucking cheap. I'm like, I can't resist.
10 seconds.
10 seconds. Whoa. Whoa. There's your first dip down.
No change. No change. Rate remains unchanged at 5.5% as expected.
Trading 540, 70.
As the Fed note that there has been modest further progress towards the 2% inflation objective versus the lack of progress that was cited in the May 1st statement. The Fed does not expect that it will be appropriate to reduce the policy target range until gaining greater confidence that inflation is moving sustainably towards the 2% target. They're seeing some weakness in the S&P and some strength in the dollar here. So the median view of the Fed funds rate at the end of this year seen at 5.1%. Previously, they saw 4.6%. Fed officials' median view of the Fed funds rate in the longer run at 2.8%, which is up from the previous 2.6%. Have posted the full dot plot on the feed for anyone interested. Fed notes that inflation has eased over the through the past year, but remains elevated. Fed says that risks to achieving the policy goals have moved into better balance. The economy continues to expand at a solid pace and job gains remain strong. Unemployment rate remains low.
Posting the dot plot right now in the Discord for you.
So the Fed projections imply 25 basis point rate cuts imply 125 basis point rate cut this year from the current level. Another 100 basis points seen next year, however. A Fed vote in favor of this policy decision was unanimous. The Fed will continue to reduce holdings of Treasury and security and MBS as well. Fed projections show that 4 of 19 officials saw no rate cuts this year. 7 saw 1 cut and 8 saw 2 cuts. Again, the median seeing just 1. Fed says there has been, again, modest further progress towards the 2% inflation objective versus the lack of progress that was cited in the previous statement.
So the Fed's saying that they do not expect it will be appropriate to reduce policy target range until gaining greater confidence inflation is moving sustainably to 2%. Fed officials' median view of Fed funds rate at the end of 2024 is 5.1%. Previous 4.6%. Fed's official median view in Fed funds rate in longer run 2.8%. Previous expectations 2.6%. The Fed is saying inflation has eased over the past year but remains elevated. So the Fed going against that most of the work is done. Also, there are risks to achieving policy goals have moved towards better balance. That's positive, not negative. The Fed also saying the economy continues to expand at a solid pace. Job gains remain strong. Unemployment rate remains low. So Timorous might be right today in the fact that the Fed is saying, fuck you, we're going to let it go and run. No rate cuts.
And rate projections.
The Fed projections imply a 25 BPS rate cut in 2024 from current level. Another 100 BPS in 2025. So we've priced in 2 rate cuts for the year. Fed saying only 1 rate cut this year. And next year to expect a full 100 BPS cut. Also, the Fed votes in favor of policy of this policy was unanimous. The Fed, we will continue to reduce holdings of Treasury securities and mortgage-backed securities. The Fed projections show 4 of 19 officials saw no rate cut in 2024. 7 saw 1 cut and 8 saw 2 cuts.
Again, up from that 2.6% seen previously.
Also from the Fed, there has been modest further progress towards 2% inflation objective versus lack of progress cited in the May 1 statement. Fed policymakers see end 2024 PCE inflation at 2.6%. Remember that number. End of 2024, they expect PCE to be 2.6% versus 2.4% in the March projection. Core is seen at 2.8% versus 2.6%. Forecasts show the 2025 PCE and core PCE inflation at 2.3% versus the 2.2% in March. So not as mixed bag here. Not super dove. Not super hawk. Mixed bag here. Jerome at 230. From what I'm reading right now down here, not dove, not hawk, neither. I might give him a little bit.
Okay, so just to recap some of those comments from the SEP. So again, rate remained unchanged at 5.5% as expected, range in the 4.25 to 4.5%. Sorry, 5.25 to 5.5% range, again remaining unchanged. So in terms of inflation, they did make upward revisions to their PCE expectations for this year and next year. GDP and unemployment rate remaining unchanged, but they did also increase the median view of the Fed funds rate. So again, they upped that to 5.1% from 4.6%.
I'd say it's a mixed bag. Neutral. I'm neutral here.
Officials saw no rate cut this year. 7 saw just 1 cut, while 8 saw 2 cuts.
I'll read that. What he just said, I'll read to you one more time. 4 of 19 officials saw no rate cut in 2024. 7 saw 1 cut, and 8 saw 2 cuts. The official statement from the Fed stating does not expect it will be appropriate to reduce policy target range until gaining greater confidence inflation is moving sustainably to 2%. Yeah, it's bearish, JXM. It's bearish, dude. We're already at a high right now, and we are priced in for 2 cuts this year. And right now, it's like wishy-washy. The 1 cut looks like it's still on the table from the voting, but the 2 cuts is questionable. Well, yeah, we know that. I don't think they cut until after the fucking election. I think they really are tied to the election. When Jerome says that he's not tied to that election, I think that's a goddamn lie. I think it's a goddamn lie. He's definitely tied into that election. I had a friend say or ask me, do I think there's an active that Wall Street doesn't want Trump as president? He wanted my honest opinion because I try to be honest with that shit, even though I'm a Democrat. He asked me if there was if they were actively trying to stop Trump becoming president. I think so. Well, I don't know. It's a mixed bag for me. On the one hand, I'm like, yeah, they're going to try to stop him because they don't like the volatility in the market. Then the devil on the one shoulder is saying, yeah, but all that corporate tax shit, they ain't going to like that more. They'll take the volatility with the fucking corporate tax shit from Trump. Trump, that's a big ace in the hole. Big ace for Trump is the not changing the corporate tax structure from 2017. That will make people fucking vote, slam the lever for Trump. I don't know if you know that, but if you're poor, you might not. But if you have some wealth, you know what I'm talking about. If you own a home, you know what I'm talking about. At a bare minimum. I can't say what I think about Trump and Biden, their impact on the economy or on the where we go and stuff like that, or if they're trying to keep Trump from being president. I can't say yes or no to that. I would think that are they actively trying to keep Trump from being president? That's a tough answer. What do you guys think? Do you guys think Wall Street wants Trump to be president or no? Not your Main Street hat. Keep your trader hat on here. Separate the Main Street hats in this chat. Just from a perspective of a market participant, do you think that Wall Street is trying to keep Trump from becoming president, or not, or they don't care, or they'd like him to be president? Whatever you think. What are your thoughts? What are your thoughts? No, it's not the one. So that's what the mistake is. There's a mistake in that. So we traded a low of this half-hour trigger down here. Looks like we're getting a little bit of upside squeeze here. Price not really. It's coming right back to where we were where we parked up here. So there's some truth. There's like a lot of lies and truth in that stuff. The statement from Biden, but there's some truth in there too. There used to be a huge tax rate. It was like 34% or some shit. And then they dropped it down to 17%. And if you are older, you remember that in 2017, there was tax advantage for you to quit being an employee and go to a contract worker basis if you were making a lot of money, and also to move a lot of your assets into LLCs for the tax benefits as well. Housing, stuff like that, businesses or commercial properties, all kinds of stuff into LLCs, not personal or partnerships. Proprietorships, I should say. Better like I don't know, Jim James owns a house. You want an LLC to own the house at that point. Oh yeah, when Trump changed that, it was everybody. It was a big movement to move all of your shit into LLCs. Wall Street wants Trump for sure. Or what do you guys think? Do you guys, not your Main Street hat, I'm not asking you if you hate Trump. As a trader, do you like the idea of Trump as president for the volatility? Do you think he brings volatility to the market or not? Yeah, that's what I think happens too. I'm with you, Bubblicious. It always, you know what it reminds me of? It always reminds me of the Bernie Bros. It always brings me back to the Bernie Bros. They're like, dude, Bernie's gonna do this for you, do that for you, do this for you, and then they don't fucking vote. Like they don't vote. They just tell you on the internet. They vote on the internet. They vote in a chat room. Did you vote? Fuck yeah, dude. I made all kinds of comments. Did you actually go and vote? No, dude. Did you mail in a vote? No, dude. Smoking weed, man. I'm like, what the fuck are you doing? Do you think that we'll dump if Trump becomes president? You think we dump? If Biden stays president, we don't? You think it doesn't matter? Do you think we get an election effect where we run up into March? A positive election effect or no? If Biden wins, we dump. So I got some mixed feelings on that, whether it's Trump or Biden, or it doesn't matter, I guess. I think, for me personally, I think if Trump becomes president, we fucking roll. We roll hard and fast. And then we're going to have a fucking insane bull run out of that. I think if Biden is president, depending upon where price is, we could run into December or March. And then we fucking have a crash. An actual market crash. Oh, shit. Both of them might not be in the election. How fucking old are these guys? I can't even believe how fucking old they are. 80 fucking 2 years old? What the fuck is that? These guys are fucking ancient. There should be why aren't they not playing fucking golf somewhere? Fucking chewing on Viagra and taking fucking, I don't know, fucking steroids and shit so they get a hard on at 90. Who the fuck? Can you believe that? God damn. Fucking 80s. Does anybody out there think 80-year-olds, any of you guys out there, it's okay, I won't yell at you or get mad at you. I just want to know, is there anybody in this audience that thinks it's fucking normal for 80 fucking 2-year-olds, an 87-year-old to be president? They'll be 87, right? I think Biden will be 87. It's like fucking... I barely think they should be driving. Did you see that astronaut fucking went full fucking ham? What do they call him? The what do you call it? The Lion movie? He like fucking did a backflip in his airplane, fucking 50 feet too low and fucking nose first into the ground. Yeah, an ex-astronaut died recently, the past week. Secondhand lion. He died secondhand lion style. Guy was 90 fucking years old flying a plane, doing fucking backflips. Woohoo! All right, I'm going to switch over now. Hold on here. I'm going to do a switch over between now and when we get over to the presser. I'm going to do some work in the background. It's going to look kind of weird in your screen for a minute. I don't know what's going to show up or not. I really don't fucking know. I really have no idea what screens are going to show. You might see some naked feet pics or something. My porn collection. Hold on here. You move that over there. Market recovering from the news. News neutral. It's not bullish. It's not bearish either, though. I think the presser is going to matter here today. So what do we got going on here? Let's see what we got going on in this thing. Settings. I don't think we need. Yeah, I think that's good enough over there. Put that up right there. What else do I got going here for you guys? Rate decision graphics. Oh, sweet. Not so bad. My cat knocked my light bars down, so I apologize for that. Where are we at right here? So this is SPY. Where's my other shit? Hold on here. Here's SPOOs, right? Whoa, man. Whoa, dude. Hold on here. Bottom right screener. Where are we going to put Jerome? Bottom right screener. Source on that. We're going to do this one right here, I think. Done. Oh, cool. Okay, that works. Okay, so we got SPOOs right here. This is SPY. Yellow. We will also do should we do the Dixon stuff? Yeah, we'll do the Dixon stuff. So, whoop. Uh-oh. What am I doing wrong here? There we go. Here's SPOOs right here. Apologize for this. Hold on here. Get rid of that. So this is SPY. Over here, we got the Dix going. Oh, we got this. What do we got here? That's way too high. $1.06. You wish. Here's Dixie. There's the DIX. And this is the 10-year bond. Well, the Bears want that. The Bears want that for sure. Here's the yield. Okay, and then what do I got to do down here? I got to do something else down here. Bottom left-hand screen. Okay, this one right here is going to be right here is going to be bam, put that up.
Bottom of the hour, see the release of the subsequent press conference with Fed's Chair Powell. Live video is available on the feed for anyone interested, starting in just under 10 minutes time now.
And then what I got here, financial juice is going to be, there's financial juice right here, I think.
Do you want to stay up to date with the latest and be on the bleeding edge of news for non-farm payrolls?
All right, so you got financial juice up.
Or financial juice.
They will scroll down talking points. So if you're looking at,
and save 92%.
It's weird because I've got the camera flipped right now. It's like right over there. Right over there is going to be financial juice, and they will scroll through. Can I make that smaller? Hold on a second here. Give me a second here. Thought I could make that smaller, that thing on the side, but it doesn't look like it can. All right, that works. That'll work. You can see that. You'll be able to see the headlines as they come across. Perfect. And then we've got the presser right here. We'll speed this up a little bit. Nope. That's fine. Playback speed 2. And as we get closer, we'll speed up the broadcast here so that we have Jerome speaking. You guys can see all this, right? They parked SPY right at the decision at 2 p.m. Hasn't moved. Meanwhile, in the background, you know the dealers are crushing everything right now. Dixie, the sell-off this morning, has recovered to $1.04.50. 10-year yield, a little bit of recovery at 4.279 right now. Let's make this a little bit bigger here so you can see this better. Make this bigger so you can see that better. Make this bigger so you can see it better. That bigger, better. This is the DIX. The DIX is sitting on its weekly trigger right now. There we go. I think that's everything for you. 7 minutes until the press conference. Thanks for joining us today. If you're just joining us first time, thank you for joining us on the show. I thought that fixed that rate decision banner, but I guess I didn't. That shit still looks like a third world country flag. Yeah, well, tell me in the chat, what do you think about the ties? Tell me in the chat, what do you think about the tie situation? What tie does he wear? What color tie does he wear? Red, blue, American, Russian flag, bananas pattern.
It's been 5 minutes time now at the bottom of the hour. See the FOMC press conference beginning with Chair Powell. Live video is available on the feed for anyone.
Tie with an apple on it. The apple tie would be fucking killer. Apple just fucking moons. Goes to 300 today. Green with a ramp on it, plaid. Plaid ties are terrible. Just Tim Apple face memes. He's got fucking yelling all over it. It's just like Yellen's head. Sunglasses and guide dog. All right, next question for you. Do you think he takes a victory lap? Do you think he's neutral in his statement, or do you think he's hawkish? Do we get dove, hawk, or in the middle? That's the next question for you. I got a more poignant question here in another moment. I got a follow-up question to that. Neutral, still work to be done, or is it data dependent? Same as it ever was. Hawk, I think he says exactly what it takes to not touch the runaway market. That's a good one, Derper. I like that, Derp Peter. That's a good one. Good answer. Small Hawk. His hands are tied on both sides. All right, so here's the follow-up question. If he's going to come out and be neutral, if he comes out in the expectation from this release is that, he's like, hey, no rate hikes, no rate cuts, data dependent. We want to see progress on inflation. Do you think he will be pressed by the journals out there? Do you think the journal people are going to press him and are you going to fuck the economy up? The over tightening. Will they ask him that? Will they put him on the hot seat for that or not? Will he answer those questions or not if he doesn't address them? Cooling CPI to the job for him. Addie's saying he will have to defend the crowd. Do you think he'll address, Addie, do you think he'll address Main Street? Do you think he'll come out and say, hey, look, I know you guys are in pain? Or do you think that he'll say to them, we've done our job. Get used to it. We're close. Data dependence, right? Situation normal, don't worry right now. Go get a loan from your parents. I saw that shit. That was fucked up. Who said that shit on? Was that Jamie Dimon that said that fucking shit? Who the fuck said it was recessions are fine. You just go to your brother or your friend or your parents and they'll help you? I was like, what the fuck? That's a rich person answer, bro. It's way out of touch, bro.
Expecting the start of the FOMC press conference.
You're telling people to go live in their mom's basement? Everything is fine. Was that Kashkari that said that shit? Oh, God. I saw that. I was like, what the fuck is that? cats. Yeah, I know. Well, here we go. Still no volume. I'm not getting any audio from this broadcast yet. No audio as of yet.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made
Powell taking the
considerable
podium now
progress
to
toward
press
both goals over the past 2 years. The labor market has come into better balance with continued strong job gains and a low unemployment rate. Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high. We are strongly committed to
SPY squeezing right now, trading 542.90
in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. I'll have more to say about monetary policy after briefly reviewing economic developments.
Purple tie.
Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.3% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, grew at 2.8% in the first quarter, nearly as strong as the second half of 2023. Growth of consumer spending has slowed from last year's robust pace, but remains solid. And investment in equipment and intangibles has picked up from its anemic pace last year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our
Dixie climbing right now, SPOO's rolling.
Participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2.0% over the next 2 years. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter. The unemployment rate ticked up, but remains low at 4%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated. FOMC participants expect labor market strength to continue. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.2% at the end of next year. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in April. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The Consumer Price Index, which came out this morning and tends to run higher than the PCE price index, rose 3.3% over the 12 months ending in May, and the core CPI rose 3.4%. The inflation data received earlier this year were higher than expected, though more recent monthly readings have eased somewhat. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.6% this year, 2.3% next year, and 2.0% in 2026. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet.
But he's harping on that 2026 right now.
Housing and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate.
Data dependent.
We'll continue to make our decisions meeting by meeting, based on the totality of the data and its implications for the outlook and the balance of risks. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families.
This is bullish, by the way. If you don't know, this is bullish for the market.
Is in service to our.
We're going to discuss why here in a minute.
We at the Fed will do everything we can to achieve our maximum employment and price stability goals.
He's focusing right now on 2026. 3 times he's brought up charts from 2026. It's important. And I'll explain later, but I've explained it on the show before. As long as they maintain rates, the banks will not attempt to roll us down.
PCE is now forecast to be 2.8% by the year end. It's already 2.75, and after today's number, there were several forecasts on the street that it would be 2.6 at the end of this month. Does that tell you that the average official expects no further progress in inflation, and in fact that it's going to get worse? And if you have this wrong, doesn't it mean that you could have wrong the outlook for rates there?
Yeah, so what's going on there is that we had very low readings in
He's trying to save the market. That's what he's going to. His answer is going to be bullshit. He's trying to save the market right now for the rest of the year.
Window a very low reading drops out and a new reading comes in. The new reading gets added to the 12-month window. So it's just a slight element of conservatism that we're assuming a certain level of incoming monthly PCE and core PCE numbers. We're assuming, a good but not great numbers. And if you put that on top of where we are now, you get a very slight increase in the 12-month reading. Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting things. If we were to get more readings like today's reading, then of course that wouldn't be the case.
Bullshit.
So it's just a forecasting device.
Bullshit until end of the year, until the election. That's bullshit.
Today's reading and then hope for more like that.
But if it comes in, just to follow up, it comes in the way you forecast it, it would seem strange for you to be cutting rates at all in context of a rising core PCE. Thank you.
He fucking knows too. They both know the truth.
I don't think it'll be appropriate to reduce rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis. And that's the test we've applied. I don't know that. I think I don't know that this rules that in or out. I mean, really, it's a forecast, a fairly conservative forecast, month by month, that would lead to slightly higher, 12 months rates by the end of the year. If we get, better ratings than that, then you will see that come down or remain the same. If you're at 2.6, 2.7, that's a really good place to be.
Nick Tamaros of the Wall Street Journal. Chair Powell, if I look at the rate projections, I see 15 of the 19 that are anticipating either one or two cuts this year, fairly evenly split between the two. And so I wonder if you could explain a little bit more the nuances or the differences there. Would 2 or 3 more inflation readings, like the one that we saw this morning, make a September interest rate cut possible?
Good question.
As far as the SEP part of that is concerned, as you know, I talk to all of the other participants on the FOMC every cycle, and we talk about their summary of economic projections and the their dot plot and everything. And what I hear and see is that people are looking at a range of plausible outcomes, and in many cases they're thinking, I don't really, I can't really distinguish between two of these. They're so close for me. These are very close calls. But we ask them to write down the most likely one, so they do. And I think as you've said, there's 15 of the 19 are kind of clustered around 1 or 2. So I think I would look at all. I look at all of them as plausible. But I look at I think that does tell you kind of what the committee thinks. But what everyone agrees on is it's going to be data dependent. No one brings to this or takes away from it, that is on the committee, a really strong commitment to a particular rate path. It's actually just their forecast, and it's a combination of their forecast and their own reaction function. But again, everyone would say that this is very data dependent, and I don't hold it with high confidence. Don't really think that they're not trying to send a strong signal that this is what I think is the right thing. It's just what they think at a given moment in time, subject to data. In terms of future meetings, we haven't, we don't make decisions about future meetings until we get there. I think in terms of what we need to see, I mentioned it earlier, we want to gain further confidence. Certainly, more good inflation readings will help with that. I'm not going to be specific about how many because, really it's going to be not just the inflation readings, it's going to be the totality of the data. What's happening in the labor market, what's happening with the balance of risks, what's happening with the...
Oh, fuck, man.
You look at all of that and you ask, are we confident? Have we reached an appropriate level of confidence that inflation is moving down sustainably to 2%? Or alternatively, do we see really unexpected signs of weakness in the labor market that would call for a response? Which is another thing that could happen. But again, we don't see that. And we see today's
employment matters more than inflation either way.
As progress and as building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
And if I could quickly follow up, did you or any of your colleagues change your interest rate projections after 8:30 or whenever you got the inflation numbers today?
So this happens too often, but it does happen. It just is, data came, I think it happened a few meetings ago. So when that happens, when there's an important data print during the meeting, first day or second day, what we do is we make sure people remember that they have the ability to update. We tell them how to do that. And some people do, some people don't, most people don't. And I'm not going to get into the specifics, but you have the ability to do that. So that what's in the SEP actually does reflect the data that we got today, to the extent you can, reflect it in one day. I think we'll see PPI tomorrow. We'll know more about the PCE reading as the month goes on, but the initial CPI reading and its, kind of first level translation to PCE, we did have this morning. We were briefed about it, and people were able to consider whether they should make changes. And
yield and dollar rising right now.
Some people generally do, but most people generally don't.
John Allen. Hi, Chair Powell. Janelle Marte from Bloomberg. As you noted, the labor market is now in many ways back to where it was before the pandemic. I wondered if you could comment on how officials are viewing that. So do you think that there still needs to be more cooling in the labor market to bring inflation all the way down to 2%? Or is there any sense that maybe the labor market is more vulnerable now?
She's wrong. That statement's inaccurate.
Those imbalances have eased.
Sure. So by so many measures, the labor market was kind of overheated 2 years ago, and we've seen it gradually move back into much better balance between supply and demand. So what have we seen? We've seen labor force supply come up quite a bit through immigration and through recovering participation. That's ongoing mostly now through the immigration channel, but still we've had some increases in prime age labor force. In terms of on the demand side, we've seen quits moving down. We've seen job openings moving down. We've seen wage increases moving from very, very high levels a couple of years ago back down to more sustainable levels. We have seen unemployment creep up now 0.6 over the course of a year or so, very, very gradually. So you put all that together, what you have is still low unemployment, still 4% unemployment, historically low. But it's moved up a little bit. It's softened a bit, and that's an important statistic. But more than that,
what kind of employment, though, Jerome?
You have payroll jobs still coming in strong, even though there's an argument that they may be a bit overstated, but still they're strong. So that's what we see. We watch the labor market, of course, and the economy as a whole, but the labor market very carefully, and that's what we see. We see gradual cooling, gradual moving toward better balance. We're monitoring it carefully for signs of something more than that, but we really don't see that.
As a quick follow-up, the surveys that make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and how does it change your view on the labor market?
So sometimes you can't reconcile the differences. You just have to look at it and try to understand, and that's why it always makes sense to look at a series, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there were job losses in the household survey, job gains, big job gains in the establishment survey. So, we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way down, are still, greater than the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic. So overall, we're looking at what is still a very strong labor market, but not the superheated labor market of 2 years ago, or even 1 year ago.
Thanks, Chair Powell. Neil Irwin with Axios. Back on the rates path, the SEP showed quite a large shift of rate cut expectations relative to March. That's a period in which the economic data flow hasn't been that dramatic a shift. Can you provide some color on what changed in attitudes on the committee over the last 3 months to see a much shallower path of rate cuts this year?
Yeah, the big thing that changed was the inflation forecast. So the inflation forecast moved up several tenths for the end of the year, and as I mentioned earlier in the, what did we take away from this? We had.
Does he look tired to you or no?
Data in the second half of last year, then kind of a pause.
He looks tired to me.
Quarter And what we took away from that was that it's probably going to take longer to get the confidence that we need to begin to loosen policy. So the sense of that is that rate cuts that might have taken place this year, take place next year. You know, we
Dixie on the move up to 104.7
this year, but there's one more.
SPY week right now.
If you look at year-end 2025 and 26, you're almost exactly where you would have been. Just it's moved later because of that progress. Now you get different data today. So we'll have to see where the data light the way. You know, the economy has repeatedly surprised forecasters in both directions, and today was certainly a better inflation report than almost anybody expected. And we'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks.
Gina. Gina Smiley, New York Times. Thanks for taking our questions. In the summary of economic projections, the long-run interest rate forecast moved up a bit. I wonder if we should read that as a sign that you think that policy is not sort of as restrictive as we previously expected. You know, how should we interpret what that means about how the committee views its current policy setting?
So two things about that. One is this. You're right, it did move up, but I want to remember to point out that long-run neutral rate of interest is a long-run concept. It really is a theoretical concept, can't be directly observed, and what it is the interest rate that would hold the economy at equilibrium, maximum employment, and price stability, potentially years in the future where there are no shocks. So it's a little bit, it's not something we observe today. Today we've got a very specific economy with all kinds of shocks we're still getting over from the pandemic. So it's, I don't think that the concept of R-star, it's a very important concept in economics and in what we do, but honestly, it doesn't really get you where you need to be to think about what appropriate policy is in the near term. But back to your original question, people have been gradually writing it up because I just think people are coming to the view that rates are less likely to go down to their pre-pandemic levels, which were very low by recent history measures. Now we can't really know that. That's an interesting dispute and discussion to have now. But ultimately, we think that things like the neutral rate are driven by longer-run, slow-moving forces, and there's a really good question about whether those really have changed or whether instead rates and the economy are experiencing a series of persistent but ultimately temporary shocks. That's been the debate, and we can't know. But in the meantime, we're making policy with the economy that we have, with the distortions that we have. And I also, to your other point, I think it is the case that as time has gone by, the question of how restrictive is policy has become one that everyone's asking, and we're asking it too. And my answer has been that policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think
half hour triggers at 5:40:30. Dix is on the move up to the 30-minute trigger.
The policy is restrictive and is having
SPY bleeding now.
We would hope for.
Trading 541.38. Hourly trigger should be at 5:38 soon.
Just to carry that a little further, should we read this as a conclusion, the combination of tipping to one cut this year?
If the Dix doesn't Dix doesn't get rejected here, we'll have a quick bloodbath. But I think it does reject. Not sure. I haven't looked at the.
That you in fact have concluded that you weren't quite there yet.
I'd be reluctant to try to draw that conclusion. I think this is about looking at the incoming data and asking how much progress are we making on inflation and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You can translate it into the language you're talking about, but to me the focus is more on we have a goal which is price stability, another goal which is maximum employment. How are we doing there? We think we've got a good, strong labor market still. We think we've been making progress toward the price stability goal, and then for a while there was a pause, and we look at today's thing and we think, well, that's a good reading, and we hope we get more like that. And in the meantime, we're asking, is our policy stance about right? And we think yes. it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking, and that's why we've been at this policy rate now for almost a year.
So just to follow up on that, I think one curious thing here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got growth that stays above long-run potential throughout the forecast period, unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that it's going to pick up pace so much in 2025?
Well, it's been coming. Where's it been coming from? We'll start with that. Clearly, a lot of some of what we've been getting is just the reversal of the unwinding of the pandemic-related distortions to both supply and demand, and that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock on the labor side, and also you get a positive supply shock when the supply conditions unwind and return to normal. So
that has helped.
Above trend potential growth, and
that is a real true point. That's a fair point.
Had the benefit of inflation.
You don't need rates for that.
Fast, actually, last year, and we'll see what the rest of this year brings. So
SPY squeezing now as Dixie rejects off the half-hour trigger.
The question is ultimately, are you down to demand? And we don't know that, though. I mean, look at today's report. If we see more like that, we can't know what the future holds. But in the meantime, we've made pretty good progress on inflation with our current stance.
Michael McKee from Bloomberg Radio and Television. The base case of the committee seems to be that there is going to be at least one rate cut this year, but your growth forecast doesn't see any slowdown in the rest of the year, nor does the unemployment forecast see any significant weakening of the labor market. And your inflation forecasts basically average out to no change. So if at the end of the year there is no change from conditions now, why would you anticipate cutting rates? What would be the point for a rate cut?
Well, we think policy is restrictive, and we think ultimately
SPY now squeezing, trading 542.51.
Eventually, you will see real weakening in the economy. So that's always been the thought, is that since we raised rates this far, we've always been pointing to cuts at a certain point, not to eliminate the possibility of hikes, but no one has that as their base case. So no one on the committee does. But so that's how we think about it, and that's what we've been getting. That's what we've been getting is good progress on inflation, with growth at a good level, and with a strong labor market. Now, ultimately, we think rates will have to come down to continue to support that, but so far they haven't had to, and that's why we're watching so carefully for signs of weakness. We don't really see that. We kind of see what we wanted to see, which was gradual cooling in demand, gradual rebalancing in the labor market while we're continuing to make progress on inflation. So we're getting good results here.
Well, to follow up, is there any kind of concern for the housing industry or financial stability, banks, in leaving rates where they are for too long at this point?
Yeah, no one's bringing this up, so finally somebody's talking about this.
The housing situation is a complicated one, and you can see that's a place where rates are really having a significant effect. I mean,
talk about commercial properties, apartments.
The housing market is to bring inflation down so that we can bring rates down so that the housing market can continue to normalize. There will still be a national housing shortage, as there was before the pandemic. There will still be one. But the distortions that we see now with lock-ins and things like that, low mortgages. In terms of banks, the banking system has been, solid, strong, well-capitalized, lending. We've seen good performance by the banks. We had the turmoil early last year, but banks have been focusing on bringing up their liquidity, bringing up their capital, and having risk management plans in place. So the banking system, seems to be in good shape.
Chris.
Thanks. Chris Rugaber at Associated Press. I was wondering if we can
on inflation, if you can tell us a little more about where you see inflationary pressure in the economy. You mentioned labor markets coming into better balance, and inflation expectations appear to be well anchored. You're seeing, anecdotal stories of the large chains like Walmart and Target are announcing price cuts. McDonald's announcing a $5 meal deal. So, people may still be unhappy about prices at the grocery store, but it doesn't seem like there's a lot of inflationary pressure left in this economy. I wonder if you could tell us more about
it. I think it's true that inflationary pressures have come down, but we're still getting high inflation readings. So, and I think you can see it in various places. In some parts of non-housing services, you see elevated inflation still, and that's probably it could be to do with wages. Goods prices have kind of fluctuated. There's been a surprising increase in import prices on goods, which is kind of hard to understand, and we've taken some signal from that, but. And of course, housing services, you're continuing to see high readings there. To some extent, that's catch-up inflation from earlier pressures. But overall, you're right. Inflationary pressures have come down. As I mentioned, the labor market has come into better balance. Wages are still running, I would say, above a sustainable path, which would be that of trend inflation and trend productivity. You're still seeing wage increases moving above that. We haven't thought of wages as being the principal, cause of inflation, but at the same time, getting back to 2% inflation is likely to require return to a more sustainable level, which is somewhat below the current level of increases in the aggregate.
Rachel. Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. There's obviously a lot of focus on how many cuts could be expected this year, but can you give us a sense of what one cut by the end of the year would actually do to the economy, what you think would be a meaningful difference if there was a cut by the end of the year, or even two?
I think if you look back in 5 or 10 years and try to pull out the significance to the U.S. economy of one 25 basis point rate cut, you'd have quite a job on your hands. So
I want you to focus on this right now, what this discussion centers around.
Matters, and I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions, and the market will price in what it prices in. I have no way of saying, we're not at that stage, so I don't know what.
He fucking knows the moment that they cut, they're going to burn this shit down.
It's a consequential decision for the economy, and you want to get it right. And fortunately, we have a strong economy, and we have the ability to
SPY squeezing right now, trading 543.21. This is good, by the way. If you're a bull, right?
Much keeping an eye.
You want
downside.
You want Jerome Powell telling you that he's not cutting rates this year, regardless of where inflation comes down. The moment that he loosens policy, the market should roll to the downside, and banks will position for that. Historically, 70 to 80% of the time, the market rolls.
Something more lasting that is affecting your policy for the rest of the year.
We always want to avoid the tendency to dismiss the parts of inflation that we don't like and just make it go away. But we had a quarter where inflation was running higher, and yes, I could stand here and say it's stuff we shouldn't have.
So the banks cannot set up to roll the market at this point, is the implication.
Low inflation, high inflation. So if you have a quarter where it's higher, we tried not to take signal from the first couple of months, but we got a third month, and we said, okay, the signal we're taking is that.
So what this does is this alleviates the markets to not have banks
that's what
position for a roll in October, September, December.
Today's inflation reading, which is very different, very much more positive. We're going to have to see what the trend is, what's going to be the.
Means market's going to fucking crank in December and March.
Confidence that inflation is moving sustainably down to 2%, and readings like today's, that's a step in the right direction. But one reading isn't. It's only one reading. You don't want to be too motivated by any single data point.
He's point blank telling you earlier that he doesn't give a fuck if the inflation comes down to 2% year over year next month, the month after, the month after, the month after.
What's your message?
And this is stopping any positioning of a rate cut.
Data, but don't feel good about
and positioning from banks to roll this fucker down. This is good for bulls. If you're a bull, you should be happy with this at this point.
I don't think anyone knows has a definitive answer why people are not as happy about the economy as they might be, and we don't tell people how they should think or feel about the economy. That's not our job. People experience what they experience. All I can tell you is what the data show, which is we've got an economy that's growing at a solid pace. We've got a very strong labor market with unemployment at 4%. It's been a long time since we've had, a long stretch of time with unemployment at or below 4%. Very long time. We had a period of high inflation. Inflation has come down really significantly, and we're doing everything we can to bring that inflationary episode fully to a halt and fully restore price stability. We're confident that we'll get there. And in the meantime, it's going to be painful for people, but the ultimate pain would be a period of a long period of high inflation. It is people who, lower income people who are at the margins of the economy who have the worst experience, who experience the most pain from inflation. So, it's for those people, for all Americans, but particularly for those people that we're doing everything we can to bring inflation back down under control.
As just a quick follow-up here, you've indicated one interest rate cut sometime this year, and I know you don't have a crystal ball up there, but a lot of people are watching and see, borrowing money remains very expensive. For everybody who's out there waiting on a rate cut, about when can consumers expect some relief?
Well, I don't have a precise date for you, but what we said is that we want to make sure that we're confident that inflation is actually moving back down to 2%. And when we are, then we can look at loosening policy. So having that kind of confidence that inflation will be at 2%, it just pays benefits to the whole economy, to all Americans for a long period of time. We had that period.
He sees the fucking crash coming in 25, 26 for sure.
Cannot think about inflation. It's just not a concern in the everyday economic decisions that they make. We were there for a long time, and our goal is to get back to that place. And we've made good progress, and we're in the phase now of just sticking with it until we get it done.
Someone should ask him, do you want to trade 6,000 or 9,000, Jerome? Which one you want?
Times. Just drawing on the change in the statement on there being modest further progress on inflation. Halfway, through the year and after today's CPI release, what have you and other committee members found that has been particularly encouraging to you? And just in terms of the conservatism, how much of that is about stickiness in shelter inflation in particular? Thank you.
So encouraging has been that growth, the growth clearly that we had last year, and particularly the second half of last year, and we continue to see still strong growth, or solid growth this year. That's been very encouraging. If you go back a year, there was a real concern about, very much slowing growth and a recession. Many forecasters had that, and that's not what happened. Instead, the U.S. is anyway, and it's in sharp distinction with many other advanced economies around the world. So that's been encouraging. I would say that today's inflation report is encouraging, but it comes after, several your reports that were not so encouraging. You ask about. Your second question was really about shelter inflation. So I think if you go back a couple of years, we know that there are renters, and then there are people who own their houses, and we have OER, which is owner's equivalent rent. And so when market-based rents go up sharply, as they did at the beginning of when the economy reopened, they really went up sharply. Those play into rollover rents much more slowly for existing tenants than they do for new tenants. And so we found now that there are big lags. So there's sort of a bulge.
Rents are burning right now, if you don't know that.
Increases in market rents. It has to get
rents are coming down everywhere.
Take several years. Nonetheless, as long as market rents are going up at relatively low levels, and they still are.
They're coming down actively right now. There's data for that too.
Slowly than we thought. We also do sort of this thing where we impute a rental value to owned homes, and that's many countries around the world do that. Some do it differently than us. It's something that the price experts have regularly looked at. It is not something that we're the only country that does. And it's not something we're looking at changing or would look at changing, anytime soon. But it's true. It's one of the very hardest things in inflation and in prices is how to think about, the services that someone is getting by living in a home that they could rent, but they're actually living in it. And some countries choose to just ignore that, but that's not how we do inflation here. We do it the way we do it, and we've been very transparent about it. And it's true that
that's not how we do it here.
We're seeing delays in realizing what's happening economically, but we understand that. We understand that very well.
Edward. Edward Lawrence with Fox Business. Thank you for taking the question, Chair Powell. So I want to go back to jobs and the consumer. The last jobs report showed that over the past year, 634,000 more people took multiple jobs. That's up 8.2%. And since January of 2021, we've seen prices rise 19%. So people are using their credit cards to pay for their lifestyle. What pressure points will signal to you that the slowing economy could maybe break companies in terms of hiring or break the consumer in terms of spending?
So, we monitor all the things you mentioned and more. What we're seeing is basically spending was going up faster than disposable income during big parts of last year rather. And so what you'd expect to see is people spending more on their credit cards. That has been happening. Credit card balances have been going up. Credit card defaults have been going up. They're not at high levels. We remember that after the pandemic, people were cooped up. They couldn't spend money. They couldn't go out to spend money. They could spend money from home. But households were in very, very strong, historically strong financial shape. They've now worked off a lot of that. So we're watching that carefully. And, what do we see? That's what we see. We see the same data that everybody else sees, but you've still got household sector that's in pretty good shape. But nonetheless, it's not in the kind of shape it was in a year or two ago. And we're carefully watching that.
So how close then are we to that point where the consumer can't continue to spend as they're spending, or companies can't hire like they're hiring?
Consumer spending is still growing. It's not growing at the pace it was growing at a year or so ago, but it's still growing solidly. And by the way, other parts of the economy are picking up. Spending on equipment and intangibles has picked up quite a bit.
The market does like this.
All the construction that we saw.
This is good for the market.
Tech plants. So overall, the economy is exhibiting solid growth, and something around 2%.
The market is digesting this positively, guaranteed.
Economy. But you're right, though. We do see the same thing other people see, which is increasing financial pressures on more lower income people, and the best thing we can do is to foster a very strong jobs economy, which we think we have done. Ultimately, to get inflation under control, because those people experience inflation, very directly, very painfully, and once we get inflation under control, rates can come down, which will also improve things.
You ain't getting no rate cuts this year.
Victoria Guida.
Or you're not going to be told if there is one. You won't be told.
Weakening in the labor market would bring rate cuts sooner, and I was just wondering, can you talk a little bit about what that
unemployment would need to be a rampant unemployment.
A quicker pace of people losing jobs? Is it more the level of the unemployment rate if it were to start to go above?
It's the velocity of it.
Or something like that. How are you thinking about what you're looking for to see the job market unexpectedly weaken?
When I say unexpectedly, the first thing is more than kind of is in our forecast or in common forecasts. So something more than that. But we'll be looking at everything. The labor market, has the ability, has the tendency sometimes to move to weaken quickly. So waiting for that to happen.
Listen to that closely.
We're doing. We're watching very carefully. We're looking at the balance of risks. I always point out the balance of risks. So, and also the fact that we look at all of the whole situation. So, a decision to begin to
unemployment can move quickly.
Could have several reasons associated with it at a given time, but I would just we monitor all the labor market data, and if we saw troubling weakening more than expected, then that would be something we'd consider responding to. But we'd look.
No, you'd be forced to respond. You would have to cut rates, bro. You know that already.
Payroll numbers would be.
I'm not going to.
Or historically, at least.
Many things would make it on that list, but I don't think I'll utter them here.
Thank you, Chair Powell. Simon Urbanovich with The Economist. May I ask, you mentioned with the slightly higher PC readings earlier this year that it wasn't 1 or 2 months, but 3 months that tipped you to be a bit more cautious in the rate outlook. Should we take from that, you know, it looks like May will be quite good for PC as it was for CPI. Does that imply that kind of 2 more good months would reinstill the confidence that rate cuts could be coming sooner than we currently project?
You know, I don't actually have that kind of mechanical thing in.
He's going to say, fuck no.
I get that. You know, as many good ones as we had bad ones, but no, it's not like that. It's the whole, it's going to be the totality.
Just tell them the truth. The moment you cut rates, they're going to fucking crush it.
Inflation. You know, you'd want to see real progress that builds your confidence that we are on a path down to 2%. And I don't want to try to give you specific numbers of things because that points to dates, and I just
the moment he gives a date, the market will be poised. The moment he tells them, like, you're getting a rate cut for sure in the end of the year, they're gonna ramp this market and park it right for the top moment. And if anything, you'd want an unannounced rate cut because you get the squeeze, then the roll.
And I have no doubt that the market should determine the exchange rate, but Japan and some emerging market are suffering from the strong dollar. So I want to know if it is having a positive impact on U.S. economy in total. Thank you.
So we don't. Actually, it's our finance ministry, the Treasury Department, that has a responsibility for thinking about and if it sees fit, doing things about the level of the dollar. So for us, it's just another financial variable. And you're right, the dollar has.
SPY squeezing now trading 543.57 on R3.
Or so because the U.S. economy is very strong. We don't think of it as benefiting or hurting.
Prior high was 543.96.
Manage the level of the dollar. That's not our job. It's not. You know, and for our economy, what we're trying to foster is maximum employment and price stability. And we feel like we've made good progress on both of those goals over the course of the past year.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you would cut rates before inflation falls to 2%. You're forecasting inflation to end the year at 2.8% on core PCE. We're at 2.8%, of course, on core PCE. Right now, you said the inflation forecast is conservative and that if you got 2.6 to 2.7 on PCE, that would be a good place to be. You also indicated the job market has mostly normalized. So why not cut rates this summer just once, you're well above neutral, to try to preserve the soft landing rather than risking waiting too long in the quest for confidence for inflation?
You know, so we're well aware of the two-sided risks here.
Tell them why. Tell them the crash is coming in 25, 26.
That could come at the cost of economic activity, of employment, of the expansion. We understand that if we move too quickly, we could end up undoing a lot of the good that we've done and have to then start over, and it could be very disruptive. So we're extremely aware of both of those risks and just basically trying to manage them. And what we said is that we don't think it'll be appropriate to begin to loosen policy until we're more confident that inflation is moving down to 2% over time on a sustainable basis.
317 right now. We're getting a little long in the tooth here. They usually wrap it up at 320 or 340.
Expected deterioration in labor market conditions. So I think that's the right way for us to think about it. That's our dual mandate there. And you know, we have a strong economy. We've got growth. All forecasts are very commonly around 2%. That's a strong growth rate for our economy. The labor market continues to print jobs at a pretty high rate. Unemployment's still low. So we have the ability now to approach this question carefully, and that's what we're doing.
And just to follow Chair Powell, do you need to be ahead of a weakening in the labor market? Otherwise, is it too late, given that the labor market is a lagging indicator, right, when you look at the monthly jobs data?
Yeah, we completely understand that that's the risk, and that's not our plan, is to wait for things to break and then try to fix them. We're trying to balance these two goals in a way that is consistent with our framework, and we think we're doing that.
Evan.
Thank you, Chair Powell. Evan Reiser with Market News International. You have mentioned before the framework review process will start in the latter half of the year. At this point, do you have any specific time frame for the start of that? Who will
SPY coming back to retest the high from earlier this morning.
Group of your
at 543.96.
Be the parameters. Do you anticipate
target above
changes to communications going forward?
So what we're thinking is
546.87.
Commence the review later or late in the year. In the meantime, as that time approaches, we will be devoting a lot of careful thought and planning to the contours of it. Within scope would certainly be communications generally. I'm not going to say that we'll look at this or that particular thing, and all the other details. We don't want to get prematurely into a conversation until it's really time to have it. And so, I'm going to leave pretty much everything else to later in the year.
Go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just one more question on housing. Can you still cut rates with shelter prices high, or will you wait until they start to moderate a bit?
I wouldn't. There isn't any one variable like housing prices moderating that would really decide against what we're doing. We've got an overall test, which is greater confidence that inflation is moving down to 2% on a sustainable basis. That's our overall test. Or alternatively, we see unexpected weakening in the labor market. So those are two different.
He's contradicting himself right now. He fucking just said if we get down to 2%, like 3/4, we ain't doing shit.
Prices, for example.
There's a reason for that, though, not because he won't. It's because if he pre-plans it, market will try to price it in.
Prices remain sticky. Could that slow down the pace of rate cuts?
I think you'd look at we'd be looking at the aggregate numbers and asking ourselves what's going on here with inflation at the aggregate level. And of course, if any price that contributed to ongoing inflation would matter. Any price that contributed to ongoing disinflation would matter too. But I wouldn't single out housing as having a special role there. Thank you very much.
So Chair Powell wrapping up his interview today. He seemed a little tired to me. That's the only thing that I could see from. He didn't see combative. He wasn't happy. He wasn't sad. He looked tired to me at best. Let's see if we can go over to this main screen over here. Shoot, hold on one second here. We'll go to the trigger screen maybe first. Let's go there first. Hang tight, boys and girls. And then I'll bring us back over here in just a moment. I thought this thing. I gotta find out why that's not working any longer. Okay, what are we doing here? Let's go back to the main screen here. And shoot, I gotta switch that one over now. Something's wonky here. Main screen. And what do I gotta do here? Bottom right screener. I think it's that one. Done. Okay. Give me a few moments here, folks. So there's a few things here. He looked tired. He did not look like he was the pumped up, taking a lap, any of that kind of stuff. Let's go back to SPX at least for the day to close out the day. No, not on trigger chart. We want the gamma chart. Yes, leave. There we go. Getting some rejection above at the call wall on 54.50. 54.50 call wall with some rejecting going on currently. This is SPX Gamma. Some supply coming into the marketplace. Let me move this back to SPY. SPY with a new high, with a rejection on that new high. Now trading lower. So there's a few things here. There's a bunch of stuff to look at. There's a bunch of stuff that needs to be looked at. Number one, we have priced in 2 rate cuts this year. They will take back that one, pricing in at least one. I don't think they take back both right now, but they will take back at least one of those rate cuts that were priced in this morning. Okay, at minimum, you're going to lose that. So be aware of that. Number two from today, I saw someone in the chat earlier saying, Captain, why do you keep thinking that the market will burn on a rate cut? I've shown you and posted the history of rate cuts. So I'm going to explain it to you, try to explain it simply for the last time. But I'm not going to show you today or try to draw it out for you today. You can do this on your own. You can go to TradingView and you can make an SPX chart or whatever you like, Dow Jones, New York, NYA if you want, the New York average, so that you can go all the way back to the start of the stock market. But the point is, though, is this. Rate cuts. Okay, let's talk rate cuts really quickly here. And we're going to not just talk about rate cuts. We're also going to talk about, hang tight here. Right here. So rate cuts, okay? You should do your own little chart at the bottom. You can put unemployment. You can put inflation, year-over-year inflation, unemployment. And you can do Fed funds rate and see the mechanics of it. Now, number one, the inverted yield curve is one of the fucking worst, say it again, one of the fucking worst indicators for the stock market to crash. As a matter of fact, people have been whining and bitching about the duration of the inverted yield curve non-stop, and it hasn't happened, right? So here's how it goes, okay? We're pricing things in, right? When the Fed tells you in advance, hey, we're gonna tighten, right? The market will price that tightening in initially. Okay? Then comes the part where rates stay flat. Okay? That's the idea. The market at that point says, okay, well, we priced in rate hikes, right? That's what you saw in 2023, right? The pricing in of rate hikes. And then the Fed says, we think we're making progress. The market in turn says, okay, they're still working right now, right? The work that they're doing is working. We're going to run the markets up now. Does that make sense? So they ran up the markets to this point, right? Now, where we are right now, there's two things that happen. If the Fed telegraphs to you as a market participant, we're going to have a rate cut on September 15th, right? The market will still ramp and position itself to fucking roll down to the depths of hell. You understand that? You have to. If the Fed does not give you that September 15th date, right, we will trade normally into that unannounced rate cut. The moment that we cut rates, we will squeeze, and then we will fucking bloodbath because the banks are not positioned for the liquidity for that event. Historically, the inverted yield curve, as I told you earlier, is a poor indicator. It's only accurate like 40% of the time. That's it. Like 40. That's a good indicator for a stock market crash. What is a good indicator for rate cuts and a crash are one important thing. Velocity and the rate of unemployment to the upside is a big one, not inflation. We've said that here many times, right? Inflation, yeah, fuck it. Unemployment is the baddie. Unemployment, and when it ramps, the Fed is left with no choice but to cut rates aggressively. Okay, so unemployment is the big one. But here's what the better part of this is. Jerome Powell today is telling you in that audience, telling the audience, I don't give a fuck about inflation. Said it. I don't care if we get readings of 2% for 6 months. I ain't cutting and I ain't telling you when we're cutting. So what that does is it allows the market to trade up and to the right until he either announces that or he does a surprise cut. My feelings and thoughts on this is that he knows that we're coming to the end of that cycle. And he's making the wager that if he leaves shit as it is right now, hey, it's still working, nothing's broken, I'll let it run hot or not hot, excuse me, let it run with rates high. And when we get to that period where we could see some kind of a major market rollover in January, March of 25, mid 2026, and he harped on that today with his charts, kept saying 2026, 2026, 2026. And that's buying time for the market to run normally as it is right now in a bull run until something bad comes along and forces that rate cut, which he likely sees coming by 2026 at the latest. That'll force his hand to cut rates. Tagging the 30-minute trigger right now on 540.50 on SPOOs on that sell down just now. 3:30, half an hour left. Take that off, take that off. We did catch a new high on the day. We don't want to see a new low in the day, do we? So far, new high in the day. No crazy low in the day as of right now. Half-hour trigger supportive. The hourly trigger down here is at 538.66. So if you are bulled up and you want to take a trade into Friday, the hourly trigger is your friend. Get rid of that. Get rid of this. And they're almost in line right now with these. See, the hourly trigger is now exactly where we're showing support. This last squeeze was at 8:30 in the morning. 8:30 this morning down here. 6 a.m. 6 a.m. is where? 4 a.m. Right here is another one. This would be giving away the entire squeeze. It's a weird ass looking green right there. So if you're a bull, I would say you're in relative safety for the trade to 6,000 into the end of the year or in March. If it takes us into March, January, something like that, you are in relative safety in the market. You're in safety. Even though we're selling down right now, this is intraday shit. We're not crashing, and that's good. Another good thing for you, too, is any of the risk that you may have associated with a rate cut in December or October or November is probably gone. So if he's not going to give you, hey, we're going to cut rates, if we get 3 great quarters of inflation coming down, we're going to cut rates in December. There'll be no positioning in like October, November, right before the election for that crash to take place at this point. So the market relatively safe right now. And he did state today that the one thing was unemployment. He was like, yeah, if unemployment starts ramping, we will be forced to take some action. Inflation, he was like, fuck it, I don't care what it says. We're just going to let it ride. I don't know if that, I think my assumption here is that he's betting that all that bad shit that's coming anyways, you know, he's like, fuck it, run it. keep rates as they are, keep the standard going, and we don't really care either way. I don't think he thinks we could recover from a roll right now. I don't think he thinks we could recover. I think we would start that crash early. And you know he doesn't want to disrupt that fucking election. You know he does not want to disrupt the election. So situation normal until after the election is done. Situation normal until end of year. That shit looks like bought and paid for the election, man. I'm telling you what. That was wild to see him say that today about inflation. No, I'm still in puts, man. I've been in puts for fucking days. They expire on the 14th. 14th. I got them till the 14th. What else? What else? I think that's all I got for you guys and that stuff. This looks like they're just taking away the 2 rate cuts right now. This doesn't look like nothing bearish or like doom and gloom. Market's going to crash, any of that sort of shit. And they're repricing right now for 1 cut. That's what they're doing. Should I be looking at my puts right now? You guys saying look at your shit? Yeah, they're coming back, but okay, so look at these fucking dealers. These dealers are like, we're gonna park this fucking bitch and zero out the entire day, right into 4 p.m. We're gonna torch everything. Nothing's gonna be in the money today, boys and girls. Where's 4 p.m.? We're almost there. So, overall today, I would say I'm going to say a few things. Overall, the bull case and bull narrative is alive and well, especially in the end of year. The second thing I would say would be that you're likely going to see a conversation, and this will be viewed as positively by the market overall and in general. You're going to see an argument come out that they're out of control, that the Fed's out of control, and they're going to over tighten into next year, and they're going to cause a recession. I think that they believe that shit's coming regardless. I really, truly believe that the Fed is like, yeah, fuck that. We got a recession or a crash coming next year, the year after, regardless. So what the fuck do we care if we get it started right now with our policy? So I would say run this fucker up to 6,000, maybe 9,000 if we can get the party really started. 7,000, 9,000, somewhere in there. And me personally, I will be exiting this market in 2025 by March. I'm already selling houses right now, so I'm fucking done. Like I am done exiting this market because I don't know when they front run it. But somewhere in that time period, like January, March 2025, it wouldn't surprise me to see them run it up into 2026. Just like straight fucking vertical. If they can, we'll trade it. We'll still fucking trade it. It's bad. It's going to be fucking bad. It's going to be like 2000 or 2008. Real bad. Really fucking bad. Historically, it's going to be really fucking bad. At latest by mid 2026. At latest, I don't know if they front run it. I don't know the timing of it. You can't really. There's no like crystal ball for that shit. But it's happening. All you got to do is it's fairly simple. You can go out there and just look up housing cycles. It's fairly simple to see. They align. They align every time. Every single time. And we're coming into one. We're coming into one next 2 years. So, but yeah, I don't know. I don't know. I take it as I'm as neutral as that rate decision was. I don't know about your situation buying a house. I'm selling houses right now. Every investor I know is doing the same thing. I'm in a large investor group. I got like 150 fucking real, true, big investors. They are accumulating cash right now. Everyone's accumulating cash, getting rid of properties that are at highs, and they're looking to buy in, 26, 27, 28, somewhere in there. We're looking to buy from you for fucking up. Not you personally, but and I am too. I want to buy too. So in that time period, I want to buy. We are coming to the end of a housing cycle. They coincide with major with major market crashes typically. All that shit's coming back to roost, guaranteed. Yeah, and someone said pay it on your debt. Absolutely. Pay your debt, pay your mortgages off. Pay your debt, pay your mortgages off. Get a job that's fucking built good for you. Recessions suck. Well, they don't suck for everybody. I worked through a recession, the 2001 crash. I worked through as a kind of like a low-level worker and like entry level out of college worker, and I did really well. I did very well in that time period, but I don't think in 2008 I would have done as well. I actually started a fucking business in 2008, and it did great. It depends on how old you are. Like your age matters in these events. If you're young, recessions can be good, or at least in my experience. If I was like a middle-aged tech worker, I'd be scared shitless. Scared shitless going into a recession. If I was like 50 years old, worked in tech, getting paid bank, I'd be scared. I'd be looking for a backup plan. 100%. You'll be replaced by someone young, right? That's what'll happen. They'll replace you cheaper. Yeah, AI is already doing that right now. Wasn't it just Google? Was it Google and Microsoft just announced another 1,500 layoffs, right? But due to AI, right? That was like a week ago, I think. We were asking questions about that in a stream earlier this week. We started out by asking about poor people that are poor. Do they deserve insurance? Do they deserve at least their housing covered? And then we rolled it into, what if you're a tech worker? Do you deserve it? Or just you deserve it because you're a tech worker? If your job is replaced. Middle-aged tech guy here. Let me ask you that question. So if you're a middle-aged tech guy here, do you think a recession would hurt you or not? Do you think if we went into a recession, it would hurt you and your employment in any way? If you're in this stream right now, if you're like middle-aged, let's say like 45 to 55 years old, are you in any way concerned about what a recession would do to you? Or are you no concern? You're too valuable? I don't know. I survived 3 layoffs at a tech company. Not sure if I can last one more. Yeah, I'm in puts right now. I'm in a fuck ton of them I've been adding and adding and adding and adding and adding. You think a bot will be doing your job in 10 years? Do you think that, let me ask you a more pointed question. I'm not trying to sound dickish or anything in this. I'm trying to be just an honest question. No motivation behind this question. I have a buddy that owns a tech company, a big one, one of the really big boys. It's private. I'm not going to tell you which one. He's not a public company, but he's huge. He outsources a lot of work to Indians. He actually has 3 offices in India, and then he has Indians come to the U.S. to work here as well. And then he's got like Americans that do some of the engineering as well. Small, like I would say 25% Americans, 75% Indians working for him. Do you think when they start replacing engineers, tech engineers, do you think that they cut the American workforce more? Do they cut the Indian workforce more than the American workforce? Is there any of that stuff going to happen or no? Has India thought about that? Don't fight the machine, run the machine. Yeah. Juan or Donna is saying his job as a commercial video creator will get reduced greatly, but the demand for having real people in video will still be there. Did you guys see the most recent AI photos of people or videos of people, AI videos? There was a guy eating pasta, or an Asian guy that was eating noodles of some kind. Did you guys, any guys see that? The cuts are made according to skill and then cost of developer. Okay. So nationality doesn't matter, come into this mix at all. Did you guys, was it with Will Smith was the original, right? Stuffing spaghetti in his mouth? Have any of you guys seen this video out there? And I'm asking the commercial video creator that question, if he's seen it. Dude, those videos of those AI people, they look like a real person. Did any of you guys see that? They look like a real person. Like acting, looking, all of it. I would not know that was not a real person. I would not fucking know. I wouldn't fucking know. It looks like a real person that's been cleaned up. Like just editing of a real person. It was passable to me. You did see it. Okay. I'm not talking about the Twitch video. I'm not talking about the avatar for Twitch. I'm talking about, like, I'm going to make a movie and I'm going to make my own actor. I'm going to have an AI actor, like literally voice, everything, feed him lines, mannerisms, motions, all that stuff. No 12 fingers either. None of that. The stuff that's coming out right now, like right now, is insane. Market holding, man. Gamma is good right now. Market holding right now. 540 is strong. Do you guys think we go down tomorrow or up? Still have 2 more sessions left. Are we done going up, or are we going to go down in a Friday? I think we go up. I think we stay up. I think we stay above this 540 here. I think we do into Friday at least. I don't think bears are going to get any relief this week. I don't think they get any relief. Yeah, I don't see us going down this into Friday. They're gonna torch every one of those everybody's getting torched on Friday. We're gonna stay up, in my view at least. Stay above 540, 538. Not until after OPEX. There's no window of weakness until after OPEX. Well, there's a window of weakness the week of OPEX. Sell down in the week of OPEX, and we rip back up again. There's like, this year is kind of weird. We got like, we've got Juneteenth mixed in there, like the market's closed one day. I think we sell down into OPEX week, or I think OPEX week we sell down. No, I think we park here at 540. I think we park here at 540. Let's take a look at SPX Gamma. Or maybe not 5. So let me show you this really quick. So here's your local support now. Right where this blue box is right here. Here's your half an hour trigger right here on SPX. I think this holds down here. This is going to hold, and they're going to start hammering this upside. Bam, bam, bam. There's some pretty fucking decent support here. If you want to see this, you can. You want to take a snapshot of that? They're going to bring this daily trigger up now. Up here, and we're going to start to begin to trade 5,500. This is going to develop. This 5,500 is going to develop on the upside. We're going up there, guaranteed. Not guaranteed, 70% chance. 70% chance we're going up there. Here you can, for now, this should help you, right? Just take a snap of that if you want. It'll change more tomorrow. You want to take a snap of that, you can. Pick your poison for buying a dip. 5,400, 53.80, baby. 54 and 53.80. We're going to trade this up. Can I discuss market breadth? I haven't looked at it in a few days. It was rolling down like 3 days ago, and then it started picking back up again. It looks like a successful rotation. What do you guys think about the medical? What do you guys think about the medical bills not being counted in your? What do you guys think about the medical bills being not counted in your credit report any longer? Do you guys know about that? So right now, if you get something major happens to you, I don't know, your leg gets cut off, it costs you $2 million to save your life. Right now, that goes on your credit report. If you didn't pay it, and you have to declare bankruptcy, and you're kind of fucked. It's included in not just those reports. It involves your background checks for employment, background checks for renting houses, all kinds of different implications. Now, Biden is saying as of yesterday, this is an old story, but he reaffirmed yesterday that it's not going to count on your credit report any longer, which would mean that if you don't have insurance, you can go places for medical insurance, or if you don't have medical insurance and get care. I don't think it's good per se, but if you don't have medical insurance, it's got to be some kind of a relief. Do you think that hurts hospitals for recovery of debt, or no? Do you think hospitals begin to lose money, profit? Oh, that Uncle JBJ, I like that. He's saying, I like that idea, JBJ. He's saying that or Uncle JBJ is saying, I think it's another way to fake consumer credit data and make the numbers look good. That's a good one, JBJ. Mr. Talking Monkey is saying good news for consumers, bad news for lenders and large item businesses. Yeah, the U.S. Healthcare system is ghoulish. It's fucking brutal. It's so fucked up. It's like a fucking Frankenstein right now. I wonder if it's like a person without insurance. I've had medical debt. When I was younger, I accumulated some medical debt, and that shit sucks. That shit really fucking sucks. That shit's on your report until you get rid of it, until you pay it. Are we trading below GME right now, the hourly trigger, or no? That's not good if we are. Yeah, that's not good. You got the new high there. You failed this new high, though. You don't want to see that failure there. You can see it already failed. This is a pretty easy sign to get the fuck out of the trade. So you got the new high right here. So you caught that new high right there. That's bullish. That's all good to go right there. You got the next pump right here, and this pump failed. This is bad. If you fail that high, which you did, right, you needed it to be right here. That was the next target. Failure on the 1 and 5 minute trigger here. So they'll go back and retest the low. At minimum, we're going to retest. At minimum, 2312. And we will likely trade $20. High probability of trading $20. I'll give you a more exact number here. Yeah, 21, 20 bucks, somewhere in there. Don't get long in here unless it recovers and catches a new high. Something like that. 1, 2, 3, boom, upside. Let it consolidate. Yeah, we get the Tesla thing too. I voted. Not that it fucking matters, does it? It doesn't matter if I voted. That's they're saying. It doesn't matter if I voted. What's the lowest I expect us going this year on SPY? Worst case scenario, 460. 460. Worst case scenario that I see right now is about 460. If you want like the doom trade to the downside, the election volatility trade, 460 on the worst. I don't see any lower than that. That's a good question. I don't think we get there though. I think we hold 500. Maybe 485 on a day, like one morning we trade down to 485 and back up to 5,000. I think that's the bricks right there. I wouldn't bet on it. It has the lowest probability of us going there, but it's still on the list. It's like a 30% chance we could trade 460. More likely trade is to 485. If you wanted to really stretch it, 485 or 4850, excuse me, on SPX. Do you guys want to see, what are you guys' thoughts on Elon Musk? What do you guys think about Elon Musk in this shareholder meeting? With your trader hat on, not your I hate Elon Musk hat. What are they doing right now? What are they doing in the after hours? 1 minute left. Forget the I hate Elon Musk. I want to know about this. Want to know about the stock market with Elon. We all know. I don't think anyone likes Elon Musk right now. It can't be too many people that like Elon Musk right now. Did you guys read? All right, we'll address Elon Musk. I read some really disturbing shit last night about him. That came out, I think the New York Times yesterday wrote an article about some really nasty shit that I did not like reading. I read the whole fucking thing too. Did you guys read that article? None of this wasn't an opinion piece. It was pulled from court records, depositions. It was fucked up. It was pretty fucked up. Yeah, it was. It was serious and accurate. It was citing court records. I'm a Tesla bull, so just don't think of me like I'm naive. I'm a bull that likes to make money, though. Yeah, I read, so that SpaceX employee, they dumped all that shit yesterday. That shit was wild. I read all that shit. You think if the reporting is true that he allocated AI chips from Tesla to Twitter, he is done? There's a lot of there's a large fucking short on Tesla right now. These guys want fucking vengeance, man. Some of that is like buying Twitter too and wanting to rip this shit out of his hands. A lot of sharks swimming. A lot of wealthy, powerful people waiting for weakness to take it all away from him. Yeah, I don't think he's doing himself any favors right now either. I don't know if he sees that or not. I don't know. I'm not talking about the Trump stuff. I'm talking about the people that backed him. I loan you some money. You do something stupid with it. I take it back from you. And the money. You owe me the money and the fucking shit you bought. It's like predatory. It's very shark, and it's like what banks do and shit. But, that's what they do to you too. I'll give you a loan. You fuck it up, I'll take back the loan and the property. No, you should. Let me see if I can find it right now. Here, I'll find it right now. I don't know if it was New York Times. I'll find it right now. I'll get it for you guys. Hold on. Let me see if I can pull it up right now. I read it late last night. It was pretty bad. Can't say that it was good. Let me see if I can find the article here. I don't know if I can find it. I don't know if it's on this computer. I'll dig it up. I got to dig it up on a different computer. It's pretty. It's pretty bad. I'll just leave it at that. I had a hard time reading it, to be honest with you. Hard time reading it. Yeah. No, this wasn't really like. This wasn't like. This was all court shit. It was kind of gross. It was like people testifying. This happened. That happened. This happened. That happened. There's a lot of corroborating evidence. I've got a family member who's a director of engineering for him, and I have never asked him about that stuff. I keep my relationship with him is I intentionally try not to find out any material stuff because I'm, participant in the stock market. I'd like to know, though. I would like to know. Yeah, it reminds me of Howard Hughes. It reminds me like it's in the same track. You guys should look up Howard Hughes. It's very similar. It's glaring how similar their tracks are. It's hard not to notice the similarities. I'll get the no, it wasn't that stuff like that. It wasn't like sex parties, that kind of stuff. It's kind of really creepy boss kind of stuff. It was kind of incelish, to be honest and frank. Yeah, okay, so I have talked about Howard Hughes here. It reminds me of Howard Hughes. A lot of his career reminds me completely of Howard Hughes. Okay, markets closed. Expectation for the rest of the week, or at least until tomorrow. I'll give you guys a write-up tonight. I do think they keep it up here. They're going to burn anyone that's trying to short this shit. They're going to keep all the money and run. Dealers are going to wrap it up. The event is done for the market at least. So I think we are trading at this point on any pullback will be bought, and we will trade 5,500. We are going to trade 5,500 my estimation, if not higher. 55.60 at the end of the month. So we're already at June 12th. We got a long way to go to get there. Between now and end of month, end of quarter, they will fucking pinstrike or trade above 55.60 on SPX. So that's a fucking magnet. We're going there in my view. So we'll be there by end of month. We only got how many sessions left? Not too many. What do we got? 13 sessions left, maybe? If that? I have to count them right now. We got one holiday in there. We got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 11 sessions to get to 55.60. 11 sessions. Find a dip. Find a dip for the end of the month. 55.60 by the end of the month. Maybe the first week of the next month, but I assume on the last day of June, which for us in the market is the 28th. That's a Friday too, so it could be on Monday, but Friday the 28th, somewhere in there. Yeah, I think it'll go that high. Abso-fucking-lutely. I wouldn't be betting against it. I can assure you that. I wouldn't bet against it. Would not bet against it. Okay. I will see you guys soon. See you tomorrow at 9:30. I apologize for this morning. It was out of my control. I thought I was going crazy this morning. Shit you not. I was like, these fucking people are not going to believe me. And as the morning rolled on, I figured it out that it wasn't me. It has to be AWS or a Sunspot or something. It was something around the country, or at least in my region, wherever I live. Yeah, dude, Addy, you can't believe how pissed off. Dude, Addy, I was like, oh, I'm going to go turn the stream on. It's the best day of the year or the best day of the quarter. We got Fed meeting. Everything's going to be awesome. And then I'm like, these fucking people think that I'm not coming on. Our website went down. Our website is hosted on AWS. It went down today. Canva went down today. Discord logging in went down this morning. There was a whole bunch of shit out there that was experiencing downages. No, it's not Michigan. So AWS server is not in Michigan. So it's not just Michigan. It was happening all over the U.S. Different points this morning. I was raging pissed. I called Bork. Bork's our developer. I'm like, dude, I don't know what the fuck is going on right now. I'm like, please tell me this isn't me. I even called Bork, dudes. Yeah, no, I went to sleep last night. I actually went to bed. I actually fucking went to sleep last night. And I didn't put my tux. I have my tux. I brought it. Do you want to see it? I brought the fucking tux for the show and didn't have time. I was freaking out. I literally have the tux sitting right outside this door right here. I'll wear it tomorrow. I'll wear the fucking tux tomorrow. But I got the tux out and everything. I was just so freaking. I was freaking out this morning. I'm like, I gotta fix this. I gotta fix that. I gotta fix this. No. It's just a regular tux. It's a black and white tux. Simple, classic tux. Nothing fancy. No ruffles. I would rock ruffles though. I would rock a sexy tuxedo, 1970 style tuxedo. Fuck yeah, in a minute. This is the tux that I keep for like I go to a funeral. This is the tux that I keep for like like events I have to go to that I don't want to stand out and I don't want to be underdressed. Like my daughter's stuff, like take my daughter for father-daughter dance type stuff. And I want to look like a fucking gigolo with my daughter at a father-daughter dance. Exactly. That's exactly what it is. The black dress that you need. I can just put it's a really nice stuff. It's a really nice tux, but it's just very, very simple and formal. Blue suede tux. Fuck yeah. I got shit like that. I wear shit like that. Some of you guys have seen some of the stuff I wear. There's some people on Twitter that I hooked up with recently at a show, at a big EDM event, that have seen me dressing up like a fucking weirdo. All right, I'll see you guys tomorrow at 9:30 in the morning. I'll try to have the brief out early tonight for you. Find a place to buy a dip is my only thing I'm going to tell you here. 538, 540, 530. Buy a dip for the end of the month. We're going up.